Sales of domestic and international plane tickets are down, and down big.
Who can keep paying these prices, Tom?
Yeah. Yeah.
Big question.
Well, there it is. And David Rosenberg, our interview of the day on inflation, we'll do that here in a bit. Right now, we advance that discussion with Lindsay Pieggs, a chief economist at Stifel. Lindsay, I'm going to rip up the script here. I can do this with you. David Rosenberg is noted for his partition of inflation, slicing it into 10, 20, 30 different partitions. Do you see a set of partitions in price change that gets us to a rapid disinflation?
I think it's very difficult to say that we're going to see a meaningful retreat in price pressures given the broad-based increase. Now, yes, there will be some categories where prices will slow their pace of ascension, and that will give the Fed at least pause that they are starting to see that more positive implication from earlier policy changes. But again, when we talk about a 1/10, 2/10 headline decline, that's not the meaningful retreat that the Fed is looking for in order to change that more accelerated pathway that they've been focused on.
There's 8 ways to measure this, but let's go to headline inflation, which I think our viewers and listeners have in their head, which is not 13% to come in London, but the idea of 8 or 9% inflation. Is it an easy task for the microcosm or the microeconomics to get us back to, say, 6.9% from 8.5%?
No, I think it's going to be very difficult. And the chairman touched on this in his comments on Friday, noting that price pressures are coming from both the demand and the supply side. And while the Fed can work to control and dampen demand, dampen consumption and investment, raising the cost of borrowing or raising the federal funds rate will do nothing to address the supply side of the equation. And so the Fed is going to face an increasingly more difficult challenge this time around than in previous cycles to get inflation under control and again back down that nearer 2% target range.
How far does the unemployment rate have to rise in your view in order to get back to that level the Fed would like to get to?
Well, I think a lot of it is going to be the duration that the Fed remains on this upward trajectory to higher rates. If it's going to take a year or longer in order to get inflation back below this range that we've seen, I think the unemployment rate could easily go up near 5%, maybe higher. Right now at 3.5%, that is markedly low. And as the chairman said, he is expecting for labor market conditions to soften. And that means a meaningful upward then trend in the unemployment rate.
The reason why I ask this is because there's a sort of perfect soft landing scenario that the Fed is looking for, where you get a greater participation rate, people coming back into the market, lowering the price pressure for wages, and leading to a disinflationary nirvana where nobody has to lose their jobs. Is that likely in any scenario in your view?
I think that's the utopic scenario, and I think that's certainly a goal that the Fed is looking for. But I think the idea of a soft landing or even a soft-ish landing has been now reduced to very low single probabilities at this time. As the Fed told us, he is anticipating and they are anticipating a period of prolonged weakness where there will be ample pain for businesses and individuals. We're already seeing growth trending negative. The consumer in terms of after adjusting for inflation, so real terms trending down towards negative territory. Even if we did see the participation rise and absorb some of that artificial slack in the labor market, I do think it's optimistic to suggest that the Fed will be able to navigate positive activity anytime soon going forward.
Lindsay, we've got a banner that we're putting out here in the dog days of August, which is real articulate. It's August. Okay, so you're sitting around trying to get to September. What is the biggest data mystery you have after Labor Day?
I think there's some big data reports, not only on Friday, awaiting the non-farm payroll reports, but it's going to be the August inflation numbers that really determine whether or not the market.
I don't mean to cut you off, but like, is it a Dallas Tribune part of that? Is it Cleveland inflation? What part of that inflation report's the mystery?
No, I think the Fed is going to be focused on the headline number. That's what's going to be driving market expectations and by extension then what the Fed feels comfortable implementing come September. Because remember, while the Fed has left the door open for an unusually large increase, to use their words, they also said it's going to be meeting to meeting. And with the market ping-ponging very dramatically between expectations for a 50 and 75 basis point, one data point will be able to tip the scale in one direction or the other. So if we see the August inflation numbers come in well under expectations in terms of providing the second month of cooling price pressures, I think that redirects expectations back to 50 basis points or less, and the Fed will capitulate, allowing that lesser increase given those reduced market expectations.
I have to be honest, Lindsay, the 50 versus 75 basis point discussion is not as interesting to me, especially at a time when all of a sudden the balance sheet roll-off is set to accelerate. And it's set to accelerate this week, and nobody's talking about it. Fed officials really did not address what they thought the ramifications would be, except to point out this paper highlighting how much this would draw liquidity out of the market. What is the ramification, in your view, economically, from the balance sheet roll-off set to accelerate?
Well, I do think that the balance sheet roll-off will help to not necessarily provide upward pressure, additional upward pressure on the long end, but help to provide a floor. So as the Fed goes forward, continuing with these rate increases, even as we see the intentional move to undermine economic growth, coupled with the balance sheet roll-off, I think the Fed will be able to control a massive downward ascent that we could have otherwise seen on the longer end of the curve. Now, the Fed isn't necessarily focused on that because they don't see that as the primary tool right now. The Fed is focused on raising that federal funds rate back to a more normal level. And given the still modest level of roll-off, I think that, again, the Fed is focused on more traditional policy metrics. But going forward, should the Fed need additional momentum, I think the balance sheet becomes a very key component of that policy increase.
Lindsay, thank you. Lindsay Piegza there,
really
at Stifel. And Lisa, to build on what you were saying, Diane Swank of KPMG messaged me yesterday, and she also agrees with you that it's much, much bigger than just September. You guys aren't alone. Diane had this to say: the amount the Fed raises rates in September is less important than the direction and the resolve to slow economic growth below potential and raise unemployment. That's what everybody's got to grapple with. It's not just September 50 or 75. It's the damage it's going to do to this economy to get unemployment up and to get inflation down.
Yeah, talk about short-term memory, right? Because that was the whole point of the Jackson Hole speeches, one after another, 50, 75, it doesn't really matter, but we're going to hold them wherever they land for a very long time, right? And yet we still heard the Megan Swibers of the world, John, pushing back and saying, okay, but their forecasts are wrong. So even though they might actually go through with this intellectually, in a practical sense, they're still going to cut rates.
Well, be of A, Tom. Hard landing. That's the call from Bank of America and the team.
Yeah, I'm with Danny Blanchflower on this, John. This is really important. The beautiful comment you had there from Diane Swank in the analysis to Alan Meltzer assumes a homogenous American labor economy. I just flat out disagree with that. To me, it's wildly partitioned, and I would focus on a part of the American economy. I'm going to put it at an amateur 60% that is flat on their back right now. I don't think you can look at this as in an aggregate basis.
So the Fed is telling you what they want to see. It gets more controversial when you start to see it.
Yeah.
And I think it's going to be very, very difficult to communicate to everyone, Lisa, that higher unemployment is the price worth paying to get inflation down. And you can already see certain politicians taking advantage of this situation, ready to basically frame the Federal Reserve as the scapegoat for what's going to come down the road.
Yeah, you're talking about Elizabeth Warren front and center, and she won't be alone. But right now, they have to get this through. And this sort of goes to the heart of the conundrum for the Federal Reserve. How long does it take for monetary policy to take effect in the economy? In other words, once you see the effects, once you see unemployment rising to that 5% level that we just heard from Lindsay Piegza, then is it too late for them to reverse course quickly, right? Or is this something that's already carried away?
This is pretty gloomy stuff, but there is some better news out there for the equity market bulls. You have a bounce this morning, up 34 on the S&P, up 0.8%. Nasdaq futures up by 1.16%. Live from New York with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Billionaire Elon Musk has sent a letter to Twitter adding reasons why he wants to terminate his takeover agreement. Musk says that Twitter may have breached their deal in 5 more ways. The letter was sent after a whistleblower alleged that the company didn't know or care to find out how many of its users were spam or robot accounts. The US says that a controlled shutdown at the Ukrainian nuclear power plant seized by the Russians would be the safest option. Artillery shells continue to land near the plant. Meanwhile, International Atomic Energy Agency monitors will assess the damage and account for nuclear material at the reactor. European Union is set to meet its gas storage filling goal 2 months ahead of its target. The bloc is bracing for a tough winter with Russia limiting supplies and energy prices soaring. Gas storage helps absorb supply shocks and provides up to 30% of fuel consumed in winter. China is battling COVID in every province despite its use of the world's strictest measures to keep the virus out. All 31 mainland provinces recorded at least one local COVID case over the past 10 days. That's the broadest exposure to the virus since early 2021. Restrictions have been increasing around Beijing and in Shenzhen, China's southern technology hub. And in tennis, Serena Williams won her first match at what is expected to be her last US Open in New York. The winner of 6 US Open championships defeated Danka Konovic 6-3, 6-3. Williams is 40. She says she wants to concentrate on venture capital firm and on having a second child. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA. Which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
The skyrocketing electricity prices are now exposing, for different reasons, the limitations of our current electricity market design. That's why we, the Commission, are now working on an emergency intervention.
Better late than never. Ursula von der Leyen there, the European Commission President, on the energy crisis unfolding in Europe. From New York City this morning, good morning. Tom Keene and Lisa Bramett. I'm Jonathan Ferro. Futures up 0.8 on the S&P 500, on the Nasdaq 100, up around about 1.15% on the Nasdaq. Yields coming back in, down 4 basis points, 3.0614%. And we turn around on crude, down 1.9%. Tom, let's call it 95.20 on WTI.
I'm going to say still, John, Brent 102 with a little bit higher level earlier. This has been the quiet story of August. I don't think anybody's
I'm with you, Tom. You've been on top of it too.
Yeah,
Triple-digit crude back on the table.
Yeah, I think it's tangible. Right now, we're going to dive into this with someone truly engaged in the future of hydrocarbons. Robert Yager is Executive Director for Energy Futures at Mizuho Americas. He is someone who's not looking at the macro and what Saudi Arabia is going to do and all that. It's actually the flow of the stuff we use. Robert Yager, I want to go to Louisiana, and where 9 pipelines cross, where long ago and far away, they built a hub district for Texaco called Henry Hub. You are expert at Henry Hub. What does Henry Hub in the New York, the national idea of our pipelines, our flow movement, what does it tell you about the price of oil in the dead of winter, February?
Well, we have a couple of things working for us, a couple of things working against us heading into winter. Last week, the best performing financial instrument on the street was distillate. That's basically heating oil. The worst performing instrument on the street, actually second worst, was gasoline. We are going to head into winter with storage at a very low level. We are threatening to see distillate storage fall below 100 million for the first time since 2003, heading into winter. At the same time, it's the end of driving season and we have plenty of gasoline. Gasoline is falling fast on the commodity side. And refiners have to figure out how to feather those two moving pieces, moving in opposite directions. They have to figure out how to make more distillate and still not make a whole lot of gasoline that kills the golden goose. Gasoline is the golden goose.
I mean, it's a golden goose, and I'll give it. We went up to 120, we come back down, and right now we're midpoint 100. I don't want you to game the price of oil, but I want you to game the urgency that's out there. Even at this level, we need to do something. What's the actual do something of the distillate, the downstream space?
It's a tough call, because when you run a barrel of crude oil through the refinery, you make 2 times more gasoline than you make distillate. Right now, a barrel of distillate is worth $66. A barrel of gasoline this morning is worth $15. You can't make more gasoline. Refiners are really in a tight spot. If they continue to add gasoline to storage, they're going to kill this gasoline market, and they have a lot of gasoline, basically 2 times more gasoline in storage than they have distillate. You don't want to kill that gasoline market. On the other hand, the refiners are already taking heat heading into winter from the government, from the Department of Energy, because they are so far behind on distillate storage. At the same time they're behind on distillate storage, Henry Hub natural gas is trading at close to $10 at a 14-year high. So we're threatening really high heating oil crisis heading into winter. We think we have an inflation problem now with gasoline, especially earlier in the summer, We're going to have an inflation problem with heating oil element in wintertime that threatens to strangle people's bills. So that's what we're looking forward to.
Looking forward to is one way to put it. Perhaps this is the context for Jennifer Granholm's comments about perhaps not exporting some of the natural gas to Europe in order to protect the pricing power and the ability to keep things under control heading into the winter. How realistic is this, and how connected are these higher heating costs in the U.S. to what's been going on over in Europe?
It's very connected. There's a correlation to everything. We are moving as many molecules of natural gas to the Eurozone to make up for Russian gas as we can. Problem is, the Europeans don't have a lot of takeaway. We can't really jam many more molecules of natural gas into the Eurozone. They're trying to catch up as fast as they can now. They finally realize they have to get off the Russian pipe, and they have to join basically the rest of the world on LNG. We were selling good amounts of LNG to South Korea, Japan, and China up to the crisis in Ukraine, and we've had to switch those deliveries basically to the Eurozone as fast as we can. It's not easy. Those deals to the Asian countries were on long-term deals. And in the meantime, we lost one of our largest LNG facilities in the Gulf Coast at Freeport. And we're trying to catch up. Now, at the same time, distillate, we blend about 4 million barrels a day. Demand's about 4 million barrels a day. Last week, we sent 1.6 million of that out as exports. So a very high percentage of our demand was exported. That's what she's upset about, because those barrels should be going into storage right now and catching up. I can't stress enough how bad this is going in, that if we fall below 100 million barrels, let's say in October or even by Thanksgiving, how are we going to catch up? How can you expect that distillate prices to be at a relatively
It's going to be very
affordable
tough.
level?
And Robert, that's why so many people are asking a question about how do you reconcile the foreign policy goals with the domestic energy issues. Robert, great to catch up. Let's do this again. Very detailed stuff. Robert Yorker there of Mizuho Americas. Get in a headline on China. China Party Congress that will pick the leadership set for October 16th. We were waiting for that date, Tom. We have that date, TK. It is October 16th.
I think it dovetails well. I'm writing up a note here. I think we ought to take surveillance to Shanghai, which is going to be the focal point. John, Hong Kong's not going to be the focal point. Beijing's not going to be the focal point as a federal location. Shanghai's going to be the focal point of the kind of city, including all the Western cities, that are going to react from that party Congress.
Lisa, do you fancy a trip to China right now, October 16th? Can you imagine if there is a COVID case ahead of October 16th, what's going to happen in some of those cities?
Yeah, well, this is the question, right? Do they announce the end some of the zero COVID, or is it going to just be lockdown after lockdown ahead of that and then protracted afterwards? I mean, we're already hearing about that. Ongoing rolling lockdowns, even as the cases decline, simply because they do not want a COVID outbreak ahead of that party Congress.
Here's the deal. Tom, we'll let you go first, see if you get in.
Yeah.
And then you can do the
See
show
if I
from
get
there.
in.
Well, you know.
Let Tom go first, and then Lisa and I'll stay here.
Yvonne Mann and I can do it. And, you know, I'm
Sure.
sorry, this is going to be a big deal.
We're going to be in a hotel
Steve Engel up there?
quarantining for like 3 weeks.
Yeah, but it's
before we
comfortable.
leave
I'll
the
take
show.
a pass, and I'll just cover the markets from here.
Yeah.
Okay. Up 8 cents on the S&P.
From here?
Futures
From bed.
positive. From bed. I've always dreamt about doing that. On the NASDAQ, at 1.14% from New York City this morning. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy, I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Delivered this very clear message that the Fed is going to do what it takes to get inflation down, even if that means pain for businesses and households.
We think it's good that the Fed is doing what it's doing. It's on the case. It's going after inflation.
If we really get weakness, if we get jobs going down, they will have to backtrack.
We certainly haven't seen the earnings collapse that many of the bears have predicted.
So right now, increased volatility. It will be a September to remember, but I think we will get through this okay.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Lisa has emailed Neil to tell him stocks are higher, just to find out what he thinks about that. Live from New York City this morning. Idea. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Stocks bouncing back up 0.8%. Fascinating conversation with the Minneapolis Fed President Neil Kashkari and our colleagues Tracy Alloway and Joe Weisenthal. The Fed President, Tom, was happy to see the stock market reaction to Chairman Powell and Jackson Hole over the weekend.
Yeah, he was. I mean, and there's going to be a lot of that. And Kashkari, you know, they're all different. He can talk the line he wants to talk. But I think it's very, very typical. It's in the back of the economic textbooks, John. But the markets matter to monetary policy. That is iconic within classic economic textbooks.
It is the quiet bit out loud, Lisa. I certainly was not excited to see the stock market rallying after our last Federal Open Market Committee meeting. So here's the question for me, and I'll ask this question of our guest in just a moment. If I'm bullish stocks, am I fighting the Fed right now?
Well, Megan Swiper would say, no, you're basically just saying that you see a different economic outlook than what they do. And how much is this really the root belief that a lot of bulls have, which is the economy is not going as gangbusters as the Fed thinks. You're going to see a disinflationary kind of tilt that's bigger than people expected heading into the winter. Oh, and by the way, things are going to get so bad by next year that the Fed's going to have to reverse course and pivot and cut rates, even though they're saying we're not going to do that. So, I mean, how much is that basically what you're doing? Not fighting the Fed, but fighting the economic outlook that they're basically using to formulate their case.
Bank of America America says hard landing. Tom, this is the line from them. The Fed wants to reduce inflation and will risk a recession to restore price stability. Hard landing, the call from them.
John, I don't know. It's 7:02 a.m. and, you know, you look at Bank of America, you look at all of it out there and the level of gloom. I mean, it is 7:02 BGT. There's no question.
Well, Tom, you tell me. Give me one reason to be bullish, and it's the only reason to be bullish right now, that everyone else is bearish.
No, that is true, and you're right. That is not a sufficient condition. I would suggest corporations will adapt in a shocking manner.
We'll see if they can adapt. Futures right now up 0.8% on the S&P 500. On the Nasdaq, we bounced back by 1 percentage point. Over the last couple of days, down about 5% on the Nasdaq, down 4% on the S&P 500. Yields were higher, now they're lower by 4 or 5 basis points to 3.0558%. The 2-year backing off as well after coming very close to the closing high of the year. In the FX market, euro-dollar 100.34, positive about 0.4%. Spanish CPI fades. We get the Eurozone figure tomorrow. German CPI, Lisa, about 57 minutes away.
Yeah, and how much do we get a sense that perhaps things are topping out, peaking out south of 9% over in Germany, which is sort of a shocking number right now, considering where it has been over the past few decades. We've got a whole host of Fed Speak today, just in case you didn't get enough over the weekend. And at the end of last week, we've got Thomas Barkin of the Richmond Fed, as well as John Williams, New York Fed president. How much do they talk about the balance sheet? I keep talking about this. Tom Barkin speaking at 8, John Williams speaking at 11 a.m. Eastern. Do they talk about the expectation of what they think we'll see as we start to accelerate the runoff, which should happen this week? We really haven't seen a big drawdown in that $9 trillion balance sheet until now. Today, we get a host of economic data, slew of housing data at 9 a.m., including house price data from the S&P Core Logic unit. How much do we get a sense of a stopping out in some of the price gains and even potentially starting to fall versus just a deceleration? We also get consumer confidence at 10 a.m., as well as JOLTS, job openings. How much do we see them continue to come down? How much is this basically the soft way of taking out some of the froth in the labor market to bring down the wage pressures that actually could help with that soft landing Goldilocks scenario? And today we've got a slew of earnings. Best Buy just came out. They did better than expected or less worse than expected, and their shares are popping. Just before I looked, when I looked at them, a little bit more than 11% in pre-market trading. We also have HP and Chewy after the bell. I'm curious about HP in particular. How much is, John, the demand from companies for hardware going down as they start to pull back on some of their expenses heading into whatever kind of downturn people are expecting?
How do consumers pull back with energy prices where they are? Lisa, thank you. Here's a headline you never want to have to say as a policymaker. This from the UK. The Prime Minister's spokesperson, Tom. Households and businesses can be confident of gas and power supply. Tom, you never want to have to say those kind of things out loud.
It's a unit and a flow basis. Did they talk about price? I don't think so.
Well, let's talk about price, Tom. Astronomical. And that's the problem for so many people. How many businesses, TK, are going to have to close confronting these kind of prices?
All of our listeners and viewers are living this, and John is living it in real time, as there's so many others with Bloomberg on the continent and with family, you know, spread out across all this. John, do you have a real confidence in a 13% inflation rate as quoted by Citigroup?
Is it going to be more than that? Citi, Tom, looking for 18. Really? Citi looking for 18. The Bank of England looking for 13. So 13 is the baseline.
Wow. I had that wrong, folks. That's my August mistake.
But Tom, honestly, once you get a 13%, what difference is an extra 5 percentage points?
It's really important.
13 is dramatic enough, damaging enough by that point. We're in a lot of trouble.
This is so important, folks, and this goes back to this homogenous, heterogeneous analysis. The Fed's talking is one America baloney.
Let's get to Seb Page, shall we? Sebastian Page joins us now, T. Rowe Price CIO and Head of Global Multi-Asset. Sebastian, awesome to catch up. I'll ask that question I asked of Lisa. If I'm bullish stocks, am I fighting this Fed?
You know, Lisa said that the Fed expects a gangbuster economy. I don't think that's the case. I actually think that not only is the Fed put gone, but there's a Fed call, in the sense that any good news gets taken away by the Fed's need to tighten. So, yes, I think you are fighting the Fed if you're bullish. It's hard to find anybody that's bullish now on your show. I saw you try with prior guests today. I just came back from a trip to Australia and Japan, meeting with some of the world's largest pools of capital. And I couldn't get anybody to say anything optimistic about the economy or markets.
Seb, I'm not going to mince words. For our listeners and viewers, this is the most important conversation of the day because of your book, Beyond Diversification. Peter Lynch called it diversification. Given the cards we have into the autumn, into 2023, what character of diversification should we be right now? Over-diversified or a more focused effort to guess the right instruments?
You know, Tom, I love that question. And the number one question around diversification is, will bonds, treasuries in particular, diversify stocks if we're heading towards recession risk? And I think they will. And in fact, we've closed our underweight bonds to go back to neutral. We've had a year where diversification between stocks and bonds has completely disappeared. The drawdown in bonds has been unprecedented, and the co-drawdown between stocks and bonds has shaken investors worldwide. So we do need to rethink portfolio construction. Tom, I would say we're going through a paradigm shift in terms of portfolio construction, and the role of bonds will be diminished, but to the extent we get growth shocks, you still want to own some treasuries.
So, Sebastian, I want to clarify what I was trying to get at earlier when I was talking about the Fed. Basically, there is a belief that the economy is so strong that it can withstand and requires a big dose of pain in terms of how high rates go and how long they have to hold them there. That was sort of the message from Jackson Hole. And then they still reiterated this soft landing scenario in one Fed official after another. The bull argument, ironically, is pushing back against that, seeing the deceleration already here, that things aren't that strong and it won't require as much pain as executed by the Fed. Do you believe that? I mean, basically, do you think that that's what people are doing right now and that you should lean against that and believe what they're saying and that basically bet on a hard landing right now?
Look, I always say you should stay invested no matter what if your horizon is, say, longer than 12 months. But we are underweight stocks at the moment. We're watching this. We're not ready to get back in. Again, we are in stocks for the long run, but we are underweight. There are ways to play a more sort of soft landing scenario from a tactical asset allocation perspective. For example, through small caps. I think small caps are already pricing in a very deep recession. And so to the extent you get a recession, maybe they will go down with the market. And to the extent that you get anything that's not as bad as that, a soft or softish landing, then maybe you have some upside at some point with small caps. It takes some courage to lean in. But the valuation spread, look, large caps are in the 90th percentile of their historical valuation relative to small caps. So large caps expensive relative to small caps. Then you get a strong dollar, which tends to be more of a headwind for large caps. So there are ways to play offense, but I don't call it offense. I call it playing aggressive defense. And one thing I would say, Lisa, is there is no doubt the tone was hawkish. In fact, there was no new information in Jackson Hole in the speech. It was a short speech, no messy press conference to mix up the message, but definitely a hawkish tone. You mentioned the word pain, resolve, unconditional. Powell mentioned price stability 10 times. How many times did he mention unemployment? 0.
We'll see if that changes at the end of the year.
It was in the case of the cost of bringing inflation down.
Yeah, Sebastian Page of T. Rowe Price. Seb, well said, buddy, on a number of things. We'll see how many times unemployment gets a mention later this year if things turn around. Doug Cass writing again, really echoing things we've said over the last couple of days. The last time the 2-year yield was 340, the S&P 500 was 10% lower. And that's the story, Lisa. And I've asked that question a couple of times now. If we've taken out the highs, briefly just yesterday, of the 2-year for the year, the highs being June 14th, do we belong somewhere near the lows in the equity market of, say, June 16th?
And be more specific, right? Is this the big tech players, perhaps, with the froth they're being taken out because they've rallied that much more than that 10% versus where we saw mid-June levels?
The headline from that conversation, Tom, you are fighting the Fed if you're bullish, from Sebastian Page of T. Rowe Price.
Yeah, I mean, the Fed, there's been a game shift here. There's no question about it. John Saravelis publishes with Deutsche Bank. We'll do that when we come back.
Let's pick up on that in just a moment, Tom. Looking forward to it. Up 0.75% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It would be the largest transfer of U.S. weapons to Taiwan in almost 2 years. Bloomberg's learned the Biden administration is preparing to sell $1.1 billion in missiles and radar support. The sale doesn't offer Taiwan any new military capacity. Still, it's likely to lead to more protests from China. Ukraine has launched an offensive along the southern front of its war with Russia. The Ukrainian military says its artillery hit Russian positions around the Kherson region. Kherson is a river port that was one of the first cities to fall to Russian troops. In the UK, Chancellor of the Exchequer Nadhim Zahawi is working on additional measures to help businesses and households with soaring energy bills. He spoke to Bloomberg TV.
We know we need to do more, because by December, January, and then of course into next year, those bills will probably go up further. So I'm preparing options for the new incoming Prime Minister to be able to do even more.
The new Prime Minister will be determined by a leadership vote in the Conservative Party that concludes next week. Billionaire Elon Musk has sent a letter to Twitter adding reasons why he wants to terminate his takeover agreement. Musk says that Twitter may have breached their deal in 5 more ways. The letter was sent after a whistleblower alleged that the company didn't know or care to find out how many of its users were spam or robot accounts. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. From servers to software to the cloud and beyond, HPE is transforming its business, and Tarek Robiati is central to the task.
Gone are the days where the CFO is just a scorekeeper. Our role as CFOs is to assist the CEO change the score.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday. markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Of cryptocurrencies today, I think now's a time to get in, it's good, or now is a time to wait to see where the market's going?
The biggest thing I would say is don't put in more than you're, fine losing.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg. Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
If Joe Biden wants to run again, I'll support him. He's done a lot of great legislation passed. He's lowered the deficit in many ways. And most importantly, he brought us back into the world of nations.
Senator Patrick Leahy there, the Democrat from Vermont, from New York City this morning. Good morning with Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Futures up 0.8%. As someone reminded me on Twitter a little bit earlier, it is Turnaround Tuesday, a bounce back on the NASDAQ of more than 1%. We like that, don't we? Down 2.8% on crude, 94.29 on WTI. Yields coming back as well. You can turn the last couple of sessions upside down. Yields were higher. They're lower now by 5 basis points to 3.054%. Just a reminder, in about 42 minutes, you'll get German CPI, ahead of Eurozone CPI. Going into that, the euro just a little bit stronger. Positive 0.4 Tom on euro dollar, 100.35.
You're a font of Germanic wisdom, and the answer there is the German 2-year, which is worth following, John, hasn't gone out to new highs, but wow, what a move up.
I think it's quadrupled, Tom, this month alone. Javier Blas of Bloomberg Opinion out on Twitter this morning on the prospect of Europe intervening into the energy market, and he said this, Tom, quote, "It's amazing the number of anti-market policies Germany is prepared to consider the very moment the market moves against Germany." That's Javier Blas, Tom, this morning.
I wonder to borrow from Ian Bremmer, if it's every nation for itself, John, as you get towards, not November, but say January or February, is going to be remarkable. Right now, we continue the American political discussion. We do this with Emily Wilkins of Bloomberg Government. And Emily, we do this off the wonderful 82-year-old Patrick Leahy, who visited with us yesterday, his new book, The Road Taken. And Emily, it was shocking to see Patrick Leahy harken back to Scoop Jackson and HHH of Minnesota and say the liberals have to have a dialogue with the conservatives. We're miles from that, aren't we?
In some regards, yes. I mean, there is certainly a giant change that has happened in Capitol Hill basically since January 6th. And it really only seems like things are getting worse. This kind of leaves President Joe Biden in this really interesting position where he's kind of having to balance two different things. Number one, he ran as the unity candidate. He ran as someone who are going to unite Democrats and Republicans, get over the partisanship, get things done. To some degree, he has done that, right? The semiconductors bill, the infrastructure bill. At the same point, he's got this speech coming up in Philadelphia on Thursday where the whole crux of the speech is going to say that Republicans are bad for democracy, that they've gone too extreme, and he's dusting off his 2020 playbook, saying that people need to vote for him, more like vote for Democrats, rather, because democracy is on the ballot.
This seems to be a zeitgeist thing right now. Great. I don't care about the zeitgeist. I care about the polls. Does the polling show a large body of America doesn't want to go for a core GOP ethos?
at this point, the polls are pretty divided. I mean, it's still looking like Republicans are going to be able to take the House. But what Democrats are banking on is that if they can just show the American people that Republicans are extreme and tie even more moderate Republicans to the more extreme elements of the party, they think that's their best shot of winning. It's the message you're going to hear from Biden. It's a message you've already started hearing from Democrats across the country, save for perhaps a few who are in these really key swing states. Those are the ones that are bright purple, and they do preach a message a little bit more of bipartisanship and working together. And so it's a little bit of every man for himself. It depends what district you're running on as to which message you're going to pick up and use between now and November.
One of my favorite charts these days in politics, Emily, is a map of the gasoline prices superimposed over Joe Biden's approval rating. And you could see it tracks pretty closely, at least in an inverse level. How much do they have the ammunition? We've had 76 straight days of gasoline price declines that have really worked in tandem with this brightening prospect for the Democratic Party. How much more is left from the people that you speak with? Is there a sense that this can really deliver what people are expecting in terms of a greater dominance this midterm election?
I mean, Lisa, it's a great thing to point out. I mean, you're absolutely right. As we've seen gas prices go down, we have also seen Biden's approval rating go up. That said, when I've asked folks about this, particularly Republicans, how do you feel? Is this going to be something that's a factor? What they've noted is, sure, gas prices are down from where they were earlier this year, but compared to where they were last year or 2 years ago, they are still up, and Americans are still feeling pressure and pain, maybe not so much at the pump, but still at the grocery store, for rentals, for mortgages, that those things are still high. And if you look at how the Biden administration, their moves in the last couple of days, that letter that Energy Secretary Jennifer Granholm sent out to oil refineries, gas is still very much on the Biden administration's mind. This is not something that they are putting a check in the box and saying mission accomplished. It's good for Democrats that it has come down, but it's not going to guarantee them any sort of win in November when you're seeing other inflation still be high and gas prices still comparatively higher to what Americans have been used to for the last several years.
Emily, can I just finish on something that's been brought up a couple of times this morning? I'm not sure you'll find many people that come on this program that would describe the former president as the great unifier. The current president, in his inaugural address back in January 2021, said this: "I pledge this to you, I will be a president for all Americans." What do you make of some of the comments coming out of the White House and his party, including the governor here in the United States in New York, Governor Hochul, who's made some disparaging comments about certain Republicans and how they should go back to Florida? Emily, what do you make of the 74 million people who voted for the former president again in the past election, who are facing some interesting comments from the current president?
You know, John, that's a really good aspect to bring up because it just shows the difficulty and the divisiveness right now, not just between Democrats and Republicans, but there is a split within the Democratic Party and within the Republican Party. And what politicians are trying to do, particularly in this midterm, where it really does matter with these swing states, where each party is trying to convince independents and members of the other party to vote for them, there's a lot of trying to figure out exactly how to thread this needle. How do you appeal to your core base supporters while also appealing to your independents and your moderates? And it leads to things like that dissonance in Biden calling himself a great unifier and then calling Republicans semi-fascists. It's an awkward balance that he really is trying to strike right now. And I think there are a lot of questions remaining on how well that's actually going to work for him to be pushing those two messages at the same time.
Emily, thank you. And very well framed, very diplomatic. Emily Wilkins there down in Washington, D.C. You wondered, Tom, whether the current president, this president, Joe Biden, addresses some of these things later this week.
Yeah, I'm glad you brought up the speech, John. There's sort of a mystery to it, I'd say, and maybe it's because it's August. John, I've got to ask you, with all the focus in your United Kingdom of the Tories, a conservative party, I'm sort of thunderstruck as I, from a distance, look at the Labour Party. How are they doing?
In terms of the polls, Tom?
Well, it's Keir Starmer, right?
Better in terms of the polls over the last year, given the troubles that Boris Johnson got into. You'll see if Liz Truss will turn that around. I think the first job for Liz Truss is never mind an election and the polls. They've got to do something about offsetting the energy situation, Tom. And
it's so different.
As the current president said, we must be a president for all Americans. Whoever leads the Conservative Party has got to be a leader for everyone in the UK facing some tough times ahead.
Interesting.
This is Bloomberg.
When I started, I had no idea it was going to turn into this. Just a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today.
It's going to be short-term.
Bloomberg Markets, The Close. Weekdays on Bloomberg.
Turn the last couple of days upside down seems to be the theme right now, both in equities and the bond market as well. Equities positive, up 0.75% on the S&P, on the Nasdaq 100, up a little more than 1 full percentage point. Talked about the last couple of days, the two previous days, down by about 4% on the S&P, down by 5% on the Nasdaq. So a bounce back. Are you bullish here? If you are, this is the message from Sebastian Page at T. Rowe Price on this program 30 minutes ago. You are fighting the Fed if you're bullish. That seems to be the theme this morning, with Neil Kashkari of the Minneapolis Fed catching up with Tracy Alloway and Joe Weisenthal, and essentially saying he wasn't excited with the market reaction after the last Fed meeting, and he was happy with some of the reaction that we've seen since Jackson Hole. I'll let you fill in the gaps there. There aren't many gaps to fill. In the bond market, 2s, 10s and 30s shaping up as follows. I said yesterday we came very close to the closing high of the year of about 342.67, just short of that level at the close yesterday on a 2-year. Intraday, though, 348. 348 and backing away. Back to 340 now, down 2 basis points to 3.4028%. That's the US, the bond market, the Treasury market ahead of the Fed in September, 50 or 75, you take your pick. I never thought we'd be stood here saying this, that for the ECB, it's 50 or 75, and you take your pick. It's usually about the Federal Reserve over the last couple of months, but all of a sudden that's on a table for the ECB. Euro dollar right now, Tom, 10026. Yeah. Bit of a stronger euro in the mix, positive a third of 1%. Spanish CPI fading just a little bit. We'll see how punchy German CPI is in about 29 minutes.
Very quickly here, John, I looked at the European Union Bloomberg Financial Conditions Index, which is really good math, and I didn't realize we're almost back to the COVID stress of February of 2020, I believe it was. It is the deterioration of it, and the speed of deterioration is just shocking.
The better news, though, for the ECB, Tom, is just the spread between Germany and Italy. In and around 230 basis points yesterday, even with yields really pushing higher. So we'll see. You've got to look at both things, haven't you? In isolation, Italian yields are much higher. More recently, German yields are much higher. But the spread between the two has been fairly contained for now at least.
Yeah, John, I looked at that last night as I considered the hotel just up from Lake Como. You know, just up the shore from George's.
In Chernobyl.
No, it's north. There's a new hotel just above Villa d'Este.
Which one's that?
I can't pronounce it. You know, I can't
well, you tell us where we're going and we'll figure out if we can make that trip.
I talked to George about it.
That trip seems a little bit more interesting for Lisa and I than maybe the other trip you were suggesting about 30 minutes ago.
I was about to say, maybe better than going to China.
I'd rather go to Italy and the lakes than quarantining in China.
Okay.
I think that's an easier sell for me and Lisa. Futures, Lisa, positive about 8 cents.
Is it the Twitter report?
I think Brammer's got the Twitter report.
I've got the Twitter report. I've got the Bed Bath & Beyond report. I'm getting kind of sick of talking about Bed Bath & Beyond, frankly, but they just reported earnings. Their shares up more than 11%. I'm sick of talking about it because the shares are up close to 200% this month, or they're coming in on that, even though they have been bouncing all over the place and face a strategic review later today, which we will get. HP Inc., as well as Chewy, also reporting later today. Those shares up just marginally. HP, I'm actually interested to see what the hardware demand is like from individuals, especially with some of the personal computer purchases really tapering off, as well as from businesses. Are they investing in offices to bring people back now that perhaps the working from home aspects are getting a little bit old? If you take a look at Twitter, let's give you the Twitter report. Basically, the new excuse that Elon Musk has for why he's going to exit stage left for this $44 billion bid for the company is because of the whistleblower who was called out. One of the chief members of the executive committee in Twitter was fired, was calling out Twitter for some of its security practices. Those shares lower by nearly 0.9%, but just the level is really notable. $39.69 versus $54.20. That was the initial price. How much damage has been done to this company? BMO coming out, actually missing expectations, softer than expected results on investment banking, and this I expect to be a theme when we get some of the investment bank reports coming up in a couple of weeks here. How much has that really removed some of the profits simply because the capital markets have been so slow? And then we still do have a little bit of optimism, at least in the crypto space. We have a 3.3% gain. Yeah, Marathon Digital gaining. Tom, the reason why it's interesting to me, and it actually is because this is, and you guys both are laughing, so you're like, how are you going to justify why you put this up?
You never talk about it.
I never talk about crypto.
The stage is yours. The stage is yours.
Okay. I will say that it is interesting in terms of the appetite for the riskiest aspects of the market. How much do people bet on this sort of resurgence in those areas that were really boosted by free money? And with the free money taken out, what remains? And I think that that's going to be fascinating. And how much strategic risk is there if a lot of the stuff does not remain, Tom?
So is that the Bramwell crypto report, John?
That's it. That's what happens when Bitcoin breaks 20K. Lisa steps up and gets interested.
Marathon Digital's moving. Not else is like, things aren't moving that much, which is interesting in and of itself. It's August, Tom. I think you put up a banner that said that a little bit ago.
It's August, that's right.
So, here we go.
Lisa, thank you.
Anytime. Thanks for saving me.
Kathy
He's like, thank
Jones
you.
just about walked off the camera. Joining us now from Charles Schwab, the chief fixed income strategist, Kathy Jones. Kathy, where do bonds fit in a portfolio? Help me here. It's August. I'm reframing for the Q4. I'm reframing for ownership of fixed income into 2023, and I'm sorry, I'm lost. Where does it fit into a portfolio?
Yeah, Tom, obviously it's been a very tough year, and there's been a lot of questions about whether bonds can deliver that diversification benefit that they have for so many years. But I would argue this, that you still get capital preservation, and now you're actually getting income in fixed income. So I think there's still a valid reason to have fixed income. Obviously, you need to be pretty strategic about the amount that you have and the type that you have. We like having higher credit quality, and we're moving out in duration as yields move up so that we can capture some of that income stream longer term.
Kathy, where does credit fit in, given the difficulties we could face later this year?
Yeah, we're very cautious on credit, particularly high yield. The spreads moved up, then they came down, they're starting to move up again, but we just don't think high yield is priced to deliver the kinds of returns we'd like to see in a slowing economy and potential recession scenario. So I'd be pretty careful on high yield. Investment grade, we think is okay. We wouldn't take a huge amount of duration risk, but some of the bigger companies with solid balance sheets should be able to deliver. And you can get decent income in investment grade corporates right now, and locking some of that in, and even a 5-year duration is going to give you north of 4%, which is not bad for an income investor.
When you look internationally, Kathy, and you look at some of the projections for the ECB raising rates possibly by 75 basis points next month, how much does that change your outlook more broadly, considering the regime that we've seen and considering how much pain we have seen transpire in the Euro project?
Yeah, our firmest conviction this year is that the yield curve will invert, and that inversion will deepen. And the harder the central banks go in that direction in terms of raising rates to crush inflation, the more likely we are to see that inversion continue. So it doesn't really change the scenario. It actually, I guess, reinforces the idea that if the ECB tightens aggressively into a very weak economy on top of the Fed and all the other central banks, it's really hard to see that we avoid some sort of global recession, and that should mean more and more inversion in yield curve.
So, and that means also the reason why you're more enthusiastic about duration. What does that mean in terms of the likelihood of the credit declines that you expect, not only in the U.S., but also in Europe? I mean, you're talking about being very cautious on high yield. What's the magnitude of the potential losses that you see versus just simply strategically being away from them as you wait for this to play out?
Yeah, it's more of a strategic decision. Obviously, triple C's, the very lowest credit quality, we're always a little bit cautious on that, but particularly that's a pro-cyclical position, and this is not the time to be in the lowest credit quality. So we think, you could see spreads widen 150 basis points or so in the high yield area, and there's just not a lot of potential reward for the risk that you're taking in that area. Now, investment grade looks a little bit stronger. A lot of these companies have turned out their debt over the long term, so we don't see quite as much risk there. But it's definitely credit is pro-cyclical, and this is not the time to be overweighting credit.
Yeah, I think I agree with that. When I look at the charts, Kathy, I just looked at a vanilla corporate piece, a quality name everybody knows, and I'm sorry, it's had an ugly August. And I look at the Bloomberg total return index, it's now down 14, even 15% from the peak. But what concerns me, Kathy, is in the last week, it's rolled over again to lower price, higher yield. What are the ramifications if that index breaks through let me get the date, John, if it breaks through the June low? I mean, it's stunning.
Yeah, I think what we're reflecting here is this combination of fear of Fed rate hikes and deteriorating economic growth. So if we break that low, I don't know that there's a huge significance to it. I don't think that we're going to see huge amounts of flows in and out based on, levels anymore. Anybody who wanted to exit fixed income or the credit markets has probably done so already at this stage of the game and moved to very short-term treasuries. But it continues to wear on this the total return in portfolios overall. You're not making money in stock, you're not making money in bonds, and I think that people just will tend to want to be in safer and safer assets if we continue to see deterioration.
Kathy Jones, Kathy, love catching up with you. Missed the piano, really do. Do you see Lizzie Burden yesterday, Tom, with a piano behind her?
Yeah.
I told her the surveillance rules that if you turn up with a piano, you've got to play it.
Yeah.
She said it wasn't in tune.
Yeah, well, that's a good
catch.
When I play, John, when I play the piano in tune, it sounds like it's not in tune. John, this drives me nuts. I'm going to get up in the pulpit right now, the surveillance pulpit.
Sure.
Bond people don't know how to justify losses. They're so out of practice on that over 20 years of a total return bull market. I'm sorry. I'm looking at the Bloomberg Total Return Index, and it's 3 years minimum catch-up, and it's rolling over to new lows.
Is that your morning rant?
That's I just don't get it, why bond people can't say bonds suck, get out of it.
Stay tuned for my morning rant on rents coming up next.
I
Have you
thought it was
seen the
on West
rental
Ham.
prices?
Yeah.
You've seen the rental, but just
4,200 in New York
I was
City.
thunderstruck. I looked yesterday for the first time in ages.
Absolutely unbelievable. We're going to hit that next.
Stunning.
From New York.
Stunning,
this is
I
Bloomberg.
say.
Keeping you up to date with news from around the world with the best word, I'm Rishika Gupta. U.S. says that a controlled shutdown of the Ukrainian nuclear power plant seized by the Russians would be the safest option. Artillery shells continue to land near the plant. Meanwhile, International Atomic Energy Agency monitors will assess the damage and account for nuclear material at the reactor. President Biden will deliver a primetime speech Thursday, slamming Republicans for what he sees as their threats to U.S. rights and freedoms. According to a White House official, the president will speak about the continued, quote, battle for the soul of the nation. He's trying to boost Democrats' chances in the November elections. And China is battling COVID in every province despite its use of the world's strictest measures to keep the virus out. All 31 mainland provinces recorded at least one local COVID case over the past 10 days. That's the broadest measure to the virus since early 2021. Restrictions have been increasing around Beijing and in Shenzhen, China's southern technology hub. A Best Buy posted quarterly profit that beat Wall Street estimates. A month ago, the consumer electronics chain warned that it was under pressure from slumping demand. Consumers are shifting more spending to travel and other services. That's after they binged on TVs, computers, and appliances during the first 2 years of the pandemic. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
think we've already turned the corner on the economy in a negative way. We're seeing things roll over, and I'm willing to bet that by December, we're complaining about deflation and real problems in the economy rather than inflation. I think we've gone too far too quickly.
Peter Chair of Academy Securities there weighing in on this economy, and he thinks that things are turning around in the wrong direction quickly. Here's the rant on rents. Here's the data. Martine Paris of Bloomberg put this one together. Look at this. 1486 is the median national one-bedroom rent for a newly listed one-bedroom, up almost 12% over August 21. More than half of US cities are showing double-digit rent hikes, with some over 30%. Martine also pointing out what's happening here in New York City. The median one-bedroom rent is up almost 40% year over year. Those with two-bedroom apartments are paying 46.7% more. The Manhattan rent now, Tom, monthly rent has climbed to $4,212, up over 27% over the last year.
There's a massive
unreal.
There's a male distribution here, John, because it's not, a Gaussian curve of fancy people out here and really destitute people there. It's hugely skewed to boring, mundane 1- and 2-bedroom rundown apartments. And it's shocking what they're asking for those.
We're all moving to Staten Island, Tom. Median one-bedroom rent,
joke. Where are we moving? Seriously,
5%.
Where's the nation moving? I mean,
TK,
where is the Staten
I mean, I wasn't even joking.
Nation?
I mean, given to some of the price action we've seen, and TK, you and I have talked about this. A lot of people, I'm one of them, logged in with a very low pandemic rate, staring down the barrel of a 40%, 50% increase. Pretty tough stuff, Tom.
Thanks to Liz Ann Saunders for retweeting out that story. Just remarkable. I've got Miami, $2,500. Miami used to be a giveaway. So much for that. Right now in foreign exchange, Shab Jalanus joins us, Chief Foreign Exchange Rate Strategist at Credit Suisse. I want to go to yen before we look at some of the other currencies. I've been waiting for a yen breakout to weaker yen. I got it yesterday, 136, 137, almost up to a 139 level. Just a quick brief on the dynamics of yen and why it matters for American and Western listeners and viewers.
So the key reason the yen is so weak is the big discrepancy that's now in existence between where Japanese monetary policy is and where basically everyone else's is. And what we saw at Jackson Hole that was interesting from BOJ Governor Kuroda was a recommitment to keeping Japanese monetary policy easy for a long time to come. And that's quite different to what we're seeing in other places. For example, even at the ECB, there's now talk of potentially a 75 basis point hike next week. So this is the underlying dynamic. It's been in play for a long time. But it's not going away. So we could see dollar yen easily take out 140.
Well, that's where I wanted to go. Is it a big figure play? Is it a seismic change? Most of our viewers and listeners can't even frame out 140, 150, whatever. But is it a 5-figure move?
I think we could go to the mid-140s pretty quickly once we get towards...
What's that mean for China?
Well, that's the other interesting element here. So Chinese renminbi now is pushing on the 690 level against the dollar. It's obviously not entirely driven by what the yen does. There's local factors too. But I think the Chinese do have one eye on the yen. And we saw the Koreans as well at Jackson Hole. The Bank of Korea governor directly mentioned the impact on the yen, on their monetary policy, on their currency. So I feel that all of East Asia is linked to some extent to what the yen is doing, at least from an FX perspective and an FX market perspective. That's going to stay the way of things going forward as well.
And the flip side of this is that, this is sort of an idiosyncratic move as a result to an extraordinary policy, and the rest of the world is not partaking in it, particularly Europe. And I'm wondering, considering the fact that we're seeing some stability and finally a retracement above parity, I should say, for the euro, do you expect that to continue as there is a more cohesive effort to really address some of the energy problems?
I think that's right. What we saw at Jackson Hole when it comes to the euro, comments from some ECB members about the valuation of the euro actually making a difference, actually mattering. Again, that's quite different to what we've seen out of Japan. We're now seeing attempts to raise supplies of gas in storage that seem to be working at this point. And now, as you say, there's even an attempt to try to address the energy price story in a more direct manner. Now, whether these things work or not in the medium term is a different issue. But right now, it gives the market some reasons to hope that at least the euro has the potential to find some kind of stability at this point, given these factors. Throw in a potential 75 basis point ECB hike as well, and you have enough reasons for the market to at least do some short covering in the euro after a long period when it looked like it was a very easy trade to keep selling it below parity.
Is a 1 euro to dollar is basically parity, pricing in a 75 basis point rate hike by the ECB?
It's certainly at least pricing in half a 50% chance of a 75 basis point rate hike, I would say, at this point. So that's where the market is, and I think if we actually get the 75 basis point hike, I would imagine the euro could push higher above parity, particularly if the market buys it, in as much as if the market believes that this is a sustainable new policy from the ECB, as opposed to simply trying to fade it by bringing down longer-term rates. Then I think the euro could find a bit of a base around parity. But we do need to see that 75 basis point rate hike. If it doesn't come, I think we will again go back below parity in euro.
Shahab, can I ask you the question that Lisa and I have asked all year, which essentially is, if we do get an upside surprise on rate hikes, how much conviction do you actually have that it leads to a stronger currency? You mentioned that it might. Is that a strongly convicted call, or are you still on the fence about that?
I think it's a base case minimum for the currency to not go down. That's the way I see it. So even if it rallies on the back of a 75 basis point hike, I think once the data come through from Europe showing the very high recession risks that we anticipate there, the euro will struggle to keep going up. So I think eventually the downward pressures will resume. But I think it's certainly helpful to have that narrative out there, because I think if it wasn't out there, we'd already be substantially below parity even right now.
John, I'm doing some fancy math here. A log regression of the weakening of yen, 2 standard deviations, is a 147.80. That's unimaginable.
Well, it was unimaginable, Tom, and things have changed.
Stunning.
Things have changed so much.
Shahab's point of 145.
Dollar yen right now 138. Shahab, great to catch up. Shahab Jananous at Credit Suisse. Lisa, looking forward to not the BOJ but the ECB, September 8th.
Yeah, how much can they really get ahead of what we've seen in terms of the weakening of the euro, and how much is what we've seen in terms of a retracement above parity, not the prospect of a 75 basis point rate hike, but some sort of agreement on how to bring energy prices lower, right? Which is it?
Great lineup in the next 30 minutes. That I can tell you, Lisa. Jeff Yu.
You're like, I'm not going to respond to that.
I've got no answer for it.
I know, I hear you.
Why would I pretend? Jeff Yu of BNY Mellon. I pretend on a lot of other things. I know. He's going to join us in about 5 minutes' time. And then it's on to David Rosenberg a little bit later this morning at about 8:30 Eastern time. I know Tom's excited for that one, as we all are. Looking at equity futures up 6 or 7/10%. The bounce fades just a little bit there. On the Nasdaq 100 up 9/10%. Fades just a little bit there. And the retracement of yields, that fades a little bit too. We're down 3 or 4 basis points on a 10-year to 3.0652%. Euro dollar in and around parity.
Snooze fest.
You want to call it a snooze fest, Tom? Up 1/4%. I think Europe is the last place you'd fall asleep right now. There is so much going on as we get you all prepared for the ECB meeting next week on September 8th from New York City. Heard on radio, seen on TV. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Right now, I think the Fed is committed to bring inflation down.
They want to make sure that they can strangle inflation.
The Fed's expecting this very soft landing. We think that that's going to be very hard for them to achieve.
I think we've already turned the corner on the economy in a negative way. We're seeing things roll over.
I still think we could get a late rally in the fourth quarter.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Bramos, and Tom Keene. It is August, and we're going to give you, in this hour, Jeffrey Yu and David Rosenberg. John, I refuse to say it's an August quiet. There's a lot going on towards that ECB meeting in September.
I refuse to say it. I think you've said it about 10 times, Tom, this August already. I think for the Federal Reserve, the takeaway for a lot of people, Tom, and the takeaway for Sebastian Page at T. Rowe Price, I thought this was the headliner this morning. You're fighting the Fed if you're bullish. You are fighting the Fed if you're bullish this market. That's the message from him about an hour ago.
And are you fighting the Hungarian central bank? This has global ramifications, John. They go up to near 12% on their rate. I mean, there's a global sense to it. It was reaffirmed today by Nathan Sheets at Citigroup talking about global recession.
A Danske Bank looking for 75 basis points from the ECB next week, Tom. 75 basis points into potentially a recession, probably a recession. I'm waiting for the German inflation numbers right now after the Spanish inflation numbers came in. Just a little bit lighter, TK, going into Eurozone CPI tomorrow morning.
And the CPI, of course, we'll be speaking with David Rosenberg, is the partition of the CPI. John, which part it gets your attention?
Shelter, without a doubt. Yep. TK, without a doubt.
Totally agree.
If we're talking about the United States, if we're talking about Europe, we're talking about energy and gas prices, TK, through the roof.
Well, the energy in Europe is there. Lisa, I want to go over to shelter. John mentioned the real estate and the rent here with New York City leading the way. To me, it's discrete, Lisa, and separate from the Fed inflation debate.
Is it though? I mean, honestly, this is a good question, especially because what the Fed is doing right now is putting a ceiling on how high housing prices can apparently go. We're going to be getting a slew of housing data today, as well as tomorrow and through the rest of the week, but it's not trickling into rents quickly enough. And this goes to the whole discussion, Tom, of how long does it take for the transmission mechanism of higher rates into lower prices and some of the basic goods that people need to pay for.
Let's get through the data so we get to Jeff Yu, John. I think that's important. Brent crude 101. John, West Texas 94 down almost $3.
Euro dollar a little north of parity at 100.29. We're positive on that currency pair by a third of 1%. German CPI month on month 0.4% in line with the estimate. Year over year 8.8%, up from 8.5. In line with the estimate of 8.8, and it's teeing up Eurozone CPI tomorrow and an ECB decision next week. The ECB next week, Tom, we've got September 13th in the diary, so a couple of weeks away, for CPI in America, September 2nd for payroll, so that's this Friday, and then September 21 for the big Fed decision, just around the corner.
30 seconds here, John. You've been waiting for this morning. Socially, 8.8% inflation in Germany is unacceptable.
Yeah, I'd say that's about 7% too much. 7 percentage points too high.
Honestly, in all my history of reading this, that's more than anything, that's the biggest shock.
Tom, you and I together have covered Europe for the best part of a decade. To see it at this kind of level, if I'd said this to you 10 years ago, I think you would have laughed me out of the room.
Yeah, well, I did.
Here we are, for other reasons. For other reasons.
Well, let's continue here now. Futures up 29. The VIX I'm watching 25.33. David Rosenberg to join us later. And now Jeffrey Yu joins us, senior EMA market strategist at BNY Mellon. It is a jumble in August, Jeffrey Yu. If you were having the next cup of coffee with Jerome Powell, what would you say he needs to watch globally for September?
Globally for September, look at what your peers are doing. Are they going to follow you and say not only are rates going to go up, but they're going to go up for a sustained period? Europe is next. What are the BOEs going to do? For such a while, market's been pricing in a quick, aggressive move by the BOE and then cuts towards the end of 23 or maybe early 24. Is that going to happen now? Because if Europe is now looking at sustained high rates for some time, then that's going to constrain global growth. And then you just ask, where is the growth going to come from?
Jeff, on your tour, meeting clients, do you meet any bulls? Because we're struggling to find them.
No, well, I am in Europe, right now. So within Europe, until there is a plan to deal with the energy situation, it sounds like behind the scenes, plans are being formulated. Then we'll just go and revisit, once we see what the plans are. But then again, being the UK, where let's just say there is a bit of a vacuum, at the very top right now. We're waiting for plans. It's really hard to know, what the outlook is, when there is just no plan.
At some point, things get better. And they come in better than expected, Jeff. Do you think the market is positioned for that kind of story? Have we seen that wash out in any way, shape or form from your perspective?
Well, I always go back to positioning, just looking at how markets have their asset allocation right now in terms of risk assets. So you're still relatively overweight US assets, you're still overweight the dollar. So there's only one direction to go. You want to wait for that trigger. So if I want to construct a positive narrative, maybe China is, not right now. We probably could use a bit more disinflation from China. But heading into next year, just as the world, needs a bit of a growth kick, that external demand may come from China's normalization story. So that's something I'm holding out for maybe 6 months or further down the line. But at this point, best to stay conservative. Go back to positioning. Where positioning is lightest in risk, where you're going to see the greater positivity.
Jeff, another way of asking what John was getting at is, have we priced in fully a recession in Europe, a downturn that flirts with recession or is one in the United States, and a sub 3% GDP handle on Chinese growth? Have we already priced that in to global markets?
So we've certainly priced in recession in Europe, just looking at how the euro is treading water around parity right now. 3%, China. So it really depends on which day, because if I look at how Chinese equities are performing, especially in the tech space, I think markets actually looking for positivity, looking for some relief on the regulatory side, looking for perhaps down the line some normalization in societal restrictions as well. So actually in China, 3% maybe headline growth investment driven, but the Chinese consumer, the household, probably not as bad. And US certainly not a recession yet, as long as the labour market's in rude health. But let's see after Friday. Maybe that could change as well.
So, Jeff, if that's the case, what would you have to see to not be quite as bearish, right? To not be quite as conservative if the positioning right now is pretty gloomy?
So to not be bearish. I think we see a peaking in inflation numbers, because then you know that the household's starting to show some restraint. And then on top of that, as Chairman Powell has already said, and probably global central banks, they're going to keep rates high probably for a little longer than expected. Then you have that dual pronged approach whereby growth is going to come off. So you need to see light at the end of the tunnel for inflation expectations. That's the bottom line.
Jeff, you and I were trained that in finance, 4 standard deviations is a substantial move. And we learned that in medicine, 6 standard deviations is maybe equivalent because of the resiliency of the human body. German inflation, as reported moments ago, off the long-term trend, is a really elegant study of 9 standard deviations. We have never seen this. How do we extricate ourselves from a 9 standard deviation move?
Well, let me tell you how our data showing the euro is trying to position itself for that. We are at 3.5 times usual level of euro holdings short. Within our positioning data, especially for the majors, anything beyond 1.5 times short or long, then I sit up and take notice. Euro's at 3.5 already. So do you chase that or do you fade it? So right now it's like heart says fade it, but head said you probably, well, you don't want to chase it, but you certainly don't want to go against that right now. So the market is pushing this. They want to see how low things can get before we get a policy reaction and, more importantly, a plan, from the European Commission, from the energy ministers. But going back to your 9 standard deviation movement, markets are really close by Euro standards to enforcing that case.
Jeff, some of these numbers, this from Goldman this morning, just reading this note, that inflation could top 22% next year in the UK if natural gas prices remain elevated in the coming months. So Citi last week at 18%. That would be the peak for UK CPI for them. Bank of England's got it at 13. Jeff, can you get your head around that kind of number in the UK, 22%?
Well, it really is going to be a struggle for the BOE to try to communicate that. And to be frank, looking at the consumption data in the UK right now, we aren't exactly seeing that retrenchment in spending. So it looks like the household is actually doing okay. So is there a gap between reality and what's going on the ground? So we need to see some convergence at this point. Until we get that convergence, we will be painful. Then I'm sorry, the central bank message is going to be very, very fierce. Hold back right now. Inflation's going to get out of control.
Jeff, does sterling trade weighted reach the John Major weaknesses of 1992?
So very loth to try to make those comparisons, because there was a depegging involved at that point. But put it this way, right? If they want to limit the fallout from an exchange rate collapse, and then we need a plan right now that could come as early as next week, right, to match the euro, at least to save the household, especially on the lower income side. That is absolutely necessary at this point. The market's anticipating that. If the new government comes short, then I think comparisons with 1992 are going to be drawn. So let's revisit time.
Jeff Few, thank you, sir, of BNY Mellon. Thanks to David Goodman here at Bloomberg for writing this story up off the back of the Goldman note.
Yeah.
This Goldman note is all centered around whether gas prices in the UK stay at these levels. Ultimately, if they do, this is the call. The UK will be forced to increase its energy cap by a further 80% in January. That would push up inflation to 22.4% and trigger a 3.4% decline in GDP. Tom, that's one hell of a call from Goldman Sachs.
It is, and the backdrop here, not to get into it in detail, is there's 2 fronts to the Ukrainian war today. And I mean, there's great activity here into the end of August, almost back 2, 3, 4 centuries, where you're racing through the summer, John, to prosecute the effort. You wonder where the war news will dovetail with the financial news in 6 weeks.
The big if here, Elisa, and it's worth highlighting, is what happens with gas. Yeah. That's the big if here.
Especially as the coalition of European members work together to try to lower those prices.
Futures right now up 0.7% on a beautiful morning here in New York City. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It would be the largest transfer of U.S. weapons to Taiwan in almost 2 years. Bloomberg's learned the Biden administration is preparing to sell $1.1 billion in missiles and radar support. The sale doesn't offer Taiwan any new military capacity. Still, it's likely to lead to more protests from China. Meanwhile, Taiwan's China Airlines has ordered 16 Boeing 787 Dreamliners in a deal valued at $2.1 billion. The airline also has options for 8 more of the planes. Deliveries are set to begin in 2025. The Boeing jets will replace China's airline's aging Airbus A330 fleet. In Europe, energy prices plunged as the EU prepares to intervene in the market. German power for next year fell as much as 26%. Dutch natural gas was down 11%. The EU is trying to prevent the energy crisis from spiraling out of control by lowering power costs. It's also trying to break the link between gas and electricity costs. Ukraine has launched an offensive along the southern front of its war with Russia. The Ukrainian military says its artillery hit Russian positions around the Kherson region. Kherson is a river port that was one of the first cities to fall to Russian troops. And billionaire Elon Musk has sent a letter to Twitter adding reasons why he wants to terminate his takeover agreement. Musk says that Twitter may have breached their deal in 5 more ways. The letter was sent after a whistleblower alleged that the company didn't know or care to find out how many of its users were spam or robot accounts. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. From servers to software to the cloud and beyond, HPE is transforming its business, and Tarek Robiati is central to the task.
Gone are the days where the CFO is just a scorekeeper. Our role as CFOs is to assist the CEO change the score.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
price of cryptocurrencies today? You think it's now's a time to get in, it's good, or now is a time to wait to see where the market's going?
The biggest thing I would say is don't put in more than you're, fine losing.
Bob's report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
We think it's good that the Fed is doing what it's doing. It's on the case. It's going after inflation. It recognizes it's going to take longer, as we look at it today, for the Fed to put inflation in check. But the main thing is they're doing it.
John Stelfus there, the chief investment strategist at Oppenheimer Asset Management. We found you a bull. We found you a bull.
I was going to say the same
It's
thing.
like the one bull we've managed to find, because we keep asking people whether they have also found bulls, and they keep telling us they haven't. We got a bounce this morning. Good morning to you. Live from New York on TV and radio alongside Tom Keane and Lisa Bramett. I'm Jonathan Ferro. On Bloomberg Surveillance, we are higher by 0.7% on the S&P. On the NASDAQ 100, we're up by almost 1 full percentage point. We're hearing from the Richmond Fed president, Mr. Barkin. He's saying the following: the Fed will do what it takes to return inflation to 2%. Does not expect inflation to come down immediately. John Van over at BlackRock, Tom, has asked an important question. He would like to see the Fed attack this question just a little bit more. Do we need to rethink the appropriate time horizon to return inflation back to target, given some of the challenges that we're facing right now?
Let's be honest. Mr. Boivin, studying in Princeton under a guy named Bernanke, his first-class future Bank of Canada head. And, John, that's the arch issue that we addressed at Jackson Hole. If you're going to go to 2%, the foreverness of it may be tangible. I thought Adam Posen was brilliant on that.
Well, Adam Posen thinks at some point we should accept, Tom, a higher inflation target.
Yeah, that
it's just too early to even entertain that, Lisa.
Can I just bring this another headline from Tom Barkin, that the pace of when the Fed gets back to that 2% inflation is uncertain. So basically not weighing in on exactly the question that you guys are talking as you ask it. So just wanted to bring that to you.
In real time, he's live blogging Bloomberg Surveillance.
Exactly.
That's what we expect from Fed presidents.
Of course.
We want them to live blog the market. We want them to live blog the show.
Is that forward guidance what he's doing?
No, there's nothing forward about it. He's saying it's uncertain. We have no clue. It's giving nothing, which perhaps is forward guidance in itself.
Maybe Kashkari was forward guidance. Let's move on right now to Megan Horniman, David Rosenberg coming up. Ms. Horniman is Chief Investment Officer at Verdance Capital Advisors and joins us. To the conversation we just had, Megan, are you a bull?
Longer term, I'm a bull. I think in the next 3 to 4 months through the rest of this year, it's going to be a really volatile time. We're coming into a seasonal period with September that tends to be very weak. We've got a lot of uncertainty from, as mentioned before, what's going on with the European gas markets, the Federal Reserve, and we also have the midterm elections coming up. So I think in the near term, expect some choppy sessions.
Well, what's interesting here, with your time at Deutsche Bank and Legg Mason, where you have to call the SPX or you have to call the Dow, whatever, the NASDAQ. At Verdance, it's about portfolios. What are you actually doing given a strategy within a portfolio? Is it focused, less diversified, or is it spread it all out, or does it just go to cash?
Well, it's always to be diversified. We do have a little bit of extra dry powder in the accounts right now. That is necessary, but it's about diversification. So what we've been doing this year, just from a portfolio standpoint, is looking at areas of the market that have basically, priced in that peak pessimism. So we want to look longer term. We're not going to look over the next 3 to 4 months with this volatile market. Instead, we'll look at this volatile market as potential opportunities for our accounts looking a little bit longer term, the next 18, 24 months. Where do we think we'll be? Where is the value?
Has the housing market priced in peak pessimism?
I think there's a lot more room to go with the housing market, unfortunately, because with interest rates where they are, with consumers starting to pull back, I don't think the housing market is really in for a very good, remainder of this year. I think there's going to be some more correction there, not necessarily a bubble bursting, but we do need a housing correction here in the near term.
So what kind of housing correction are we looking at? And at what point will it lower the rents for the likes of John Farrow, who might be looking for another apartment?
I think you've got a little bit room to go. We just started to see some deterioration in this housing and in this housing data. And what we saw recently was you need to see that inventory build up, and we're starting to see it from the new home sales perspective, existing home sales. Once that inventory buildup really starts to increase, then you could see some I guess, a moderation there in that rents.
Megan, where do bonds fit in at Verdant's?
We're really defensive with the bond market. We stay very short duration. We don't have a lot of credit exposure. In fact, I'd be very concerned about credit exposure right now, given what the Fed's going to start doing in September by aggressively, reducing that balance sheet. So I think you should be very defensive. Short-term floating rate instruments. Be careful of investment-grade bonds. Be underweight high yield at this point as well, and any kind of structured credit as well.
Megan, thank you. You're not alone on that one, that's for sure. Megan Horniman there of Vernon's Capital Advisors. Lisa, too early to look ahead to payrolls? I don't think it's too early to look ahead to payrolls. No. 300K is the estimate right now, down from a previous number of 528. In that nice little montage of us pushing ahead, promoting payrolls 5 minutes ago or so. Lisa, you talked about the good news, bad news, good news. Is bad news just bad news this Friday, given what the Fed is telling us?
Yeah, that basically, if you get bad news, if you get a weaker than expected number, people might see a 50 basis point rate hike as getting locked in, right? Not a 75 basis point rate hike at the September meeting. And then what does the market do on that is another question, right? Does the market rally? And that's where bad news could become good news, which is head spinning and exhausting. And that's where I think we are in this market. And
then ultimately the Fed pushes back because this is what they want to see.
Right, exactly. I mean, I'm going to push back against payrolls being an important number. I think it is an important number, but I think CPI is going to be more important and more instructive when it comes to whether they hike 50 or 75 basis points.
Upside surprise or downside surprise, it'll be 50 or 75. And basically, that's what Bostic of Atlanta told us on Friday, almost verbatim. He said that. I want to go back to the comments of Diane Swonk, though, just yesterday out on Twitter. The amount the Fed raises in September is less important than the direction and the resolve to slow economic growth below potential and raise unemployment. Lisa's been on top of this, Tom. What's going to happen when unemployment starts climbing? Can we just keep asking that question? How are people going to respond to that if this Fed keeps saying we're going to hike? And they're setting us up for that. They're telling us that is their reaction function, that is the goal, the objective. When unemployment starts climbing, even if that's the case, we've got work to do. Let's get CPI lower.
An overestimation of the simplicity of these functions, these reaction functions. And the answer is, John, I think they're far more complex than simple analysis. And if the unemployment rate goes up, there's the haves, have-nots debate and all that. There's any number of conditions that can get you to 4% or other conditions that can get you to 5% unemployment.
We need a different perspective, and we've got the perfect guest for that up next. David Rosenberg, the founder and president of Rosenberg Research, is going to be joining us in around about 5 minutes' time. Looking forward to that. To get you up to speed on the price action, here's a snapshot. We fade just a little bit off session highs on the S&P, up 0.6%. Moving higher by about 24 points on the Nasdaq 100, up 0.8% after a two-day rout on the Nasdaq 100, raised about 5 percentage points off that index. In the bond market, yields lower by a couple of basis points. The 10-year, 3.0801%. And barking of the Richmond Fed, recession is the risk in getting inflation under control. I think that captures the story perfectly. From New York, this is Bloomberg.
things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg. Markets are preparing to close, but the day is not over yet.
Stock that is now up about 45%.
A lot of volatility right now.
You need the power of the Bloomberg terminal to get you market-moving data before anyone else.
These numbers are much higher than expected.
Upgraded today to overweight.
You need top analysts to bring you exclusive global insight into cross-asset markets.
The muni bond market.
China is a really big focus.
Bitcoin ain't playing along today. It's going to be short term.
Bloomberg Markets, The Close, weekdays on Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
Live from New York. Good morning to you. This morning on TV and radio, this is Bloomberg Surveillance with Tom Keene and Lisa Bramett. I'm Jonathan Ferro. Futures with a bounce up 5 or 6 tenths of 1% on the S&P. I have to say that bounce is fading fast. Going into the open in about an hour away. The Nasdaq higher by, let's call it 3/4 of 1%. Yields in just a couple of basis points now, down about 2 to 3.0782% on a US 10-year. A little bit later, Lisa guided you through the data to expect. I'll go through it again for you if you missed it. Some house price data out a little bit later this morning at 9 Eastern. Then we get the consumer confidence numbers from the conference board at 10 o'clock. JOLTS job openings at 10 a.m. Eastern as well, Tom. We know that's become somehow an important figure for all of us looking at this labour market, looking for that to back away to about 10.3 million, 10.4 million or so for the month of July.
John, thanks. David Rosenberg joins now with Rosenberg Research. He is the best in the world at parsing inflation. I will not mince words about it. David, on the Bloomberg, I can look at CPI inflation back to World War I, and the average over the many 110 years is 3.1%. Part of that are the spikes up, which are hugely stochastic and come down quickly. Will we disinflate rapidly?
I think we will, Tom, and I think that you're already seeing it in a lot of indicators. I'll mention 3. Commodity prices are well off their highs, even though oil prices have hung in the past couple of weeks. They're down more than 20% from the peak. Base metal prices are down 25%. You've got lumber is down more like 70%. So the commodity complex, which hasn't shown up yet, in that 40% chunk of the CPI called goods, the stuff that you can see, touch, and feel, commodities are deflating. You've got freight costs across the board. I mean, look at the Baltic Dry Index.
Yes. And I want to stop there, David.
The U.S. dollar is up 12% year over year. Does anybody in the world think that you've seen all the pass-through from the strength in the dollar into goods prices? And the answer is no. This will all show up in the next 12 months.
David, Liz Ann Saunders featured Baltic Dry Index yesterday. Explain to our global audience the symbolism of the cratering of the Baltic Dry Index.
Well, I think a lot of it is the byproduct of the fact that global demand is coming under downward pressure. I would also say that we are seeing, notwithstanding the ongoing war in the Ukraine, which doesn't seem to make the front pages of the paper anymore, you are starting to see an unclogging in a lot of the port congestion globally. And so you're seeing the supply side thaw out. You know, where are you seeing that most evidently, Tom, is in the survey data on supply delivery delays, which have come down dramatically across every single survey. Richmond Fed, Kansas City Fed, Philly Fed, New York Empire. And, you know, what's very interesting from a Fed perspective is that, you know, about 5 months ago, Jay Powell said that, you know, we're going to operate policy blindly relative to what's happening on the supply side. The Fed made a decision 5 months ago that we're just going to concentrate on demand destruction, getting demand growth below supply, which I think is a wise policy. But you see the supply side is finally taking hold and creating the disinflation before you've ever even seen any of the lagged impacts that the Fed has already done, you know, through rates and QT on the demand side. So you have the supply curve actually becoming more elastic at a time when the Fed is engaging in a policy that's going to really kill demand. So explain to me, as we get the chalkboard out and you draw these demand supply curves, how does inflation not absolutely collapse in the next year? You know, I say this to my clients. They look at me like I'm crazy.
Well, we know that.
No, not all of them do. Megan Swiber over at Bank of America would not look at you like you're crazy because she's still expecting rate cuts next year. And it's not because she doubts the reaction function from the Fed, but she also sees the prospect of inflation coming down very rapidly as we head into the second half of 2023. At what point, and this is really head spinning, does this become in some ways good news for the market because they can start to price in a softer touch or a softer approach from the Federal Reserve?
Well, so what's going to happen at some point, and who knows when, with this Fed in particular? I mean, when Neil Kashkari becomes the biggest hawk on the FOMC, you know you're in a whole new world altogether. So what happens historically is the Fed pauses. And a tightening cycle always ends, just like an easing cycle always ends. And then with the pause, you get a relief rally. But then what happens is that the recessionary pressures take hold. Then what happens is the Fed cut rates, and we've seen this so many times in the past, and you get another relief rally. And then once again, the recession pressures take hold. When they pause, you want to be very wary about the relief rally. You can rent it, you can't own it. And even after the first rate cut in a recessionary bear market, the market doesn't bottom after the first rate cut. You know when the market bottoms after the last rate cut. After you get the last rate cut and the market sees the whites of the eyes of the recovery, that's the fundamental low.
Yeah,
you know, that might be 12 months from now. So beware, the pause will generate headline news. You folks report on the pause, then they'll cut rates, and then we'll have a pop in the market, and everybody will think that, you know, the bull market's right in front of us. But no. If you want to pay attention to the historical record, and we know that history rhymes, the time to go super long the markets to understand when the fundamental low is actually after the last rate cut, when the Fed re-steepens the yield curve. Usually the 2s10s curve is plus 140 basis points, median and mean, by the time the market bottoms. We are so long away from that right now, it's not even funny.
Well, but David, to John's point earlier on the show when he was talking to Sebastian Page, he said, is being bullish fighting the Fed right now? Because exactly what you pointed to, Neil Kashkari coming out and saying he was disappointed to see that the market was rallying after that Powell speech, and that he isn't terribly unhappy and maybe even happy to see that the market is selling off in response to the latest guidance. How much are we looking for a weakening in the tightening in the financial conditions in order to satisfy the Fed's desire in terms of transmitting their policy?
Right. Well, that's the question. I'm paying attention to what the Fed is telling us. I think they're wrong. I think that Powell's already told us we are operating policy without focusing on what's happening on the supply side of the economy. Of course, after 16 months, the grand total of 16 months, which in the annals of economic history is still transitory, the Fed has given us valuable information. We are operating policy without actually focusing on what's happening on the supply side anymore. They're not relying on the fact that these bottleneck pressures are going to continue to ease, although all the data are showing that they are easing. So they're focused on the demand side. So the question becomes, given where the Fed sees the supply curve going, how far do they have to contract demand? How far do financial conditions have to tighten to get to that holy grail? In their model, I would say, and I've tried to copy their model, it's the lowest 3,100 on the S&P, okay? And high yield spreads are 700 basis points.
David.
That's the matrix. That's the combination that we'd have to get to make Kashkari more comfortable with where the markets are going.
There's a little bit of the Rosenberg humor there this morning. David, off of Jackson Hole, in the codification of 2% is the goal, is the idea that it's not one America. I've been talking all morning about a heterogeneous America, heterogeneous outcomes. It is a challenge for any central bank. What does the Fed do about 2, 3, and even 4 Americas? Blanche Flower is apoplectic over the oddities of the American labor market. Do they need to look at us as one America, or can they study 2, 3, or even 4 Americas?
No, I'd say that monetary policy has to be a national policy. You can't carry out a policy based on a couple of segments of the economy or a couple of socioeconomic segments. I know, look, this time last year, Jay Powell was sounding more like a social worker. You really have to take a national approach. And I'd be the first to say, by the way, that, you know, with the unemployment rate where it is, the participation rate where it is, that's obviously on the Fed's mind, is the tightness of the labor market. This is so bizarre, Tom, that we would have had a year, the debate about GDI and GDP is a complete waste of time. Let's take both measures together and just come to a conclusion that the economy is flat, whether you look at it from an income perspective in real terms or spending. It's basically a flat economy. And here the consensus is 300,000 on non-farm payrolls on Friday. Does anybody stop to think, why would a flat economy need to be adding any jobs at all? That's the oddity. Unless you think potential is negative, which to me is ridiculous. So I think at some point, let me just say at some point, and this is where the tightening policy by the Fed is kiboshed, is when you start to see the erosion hit the labor market. I think that's really what they're waiting for.
Well, David, you just touched on it. I'll be a little bit more diplomatic. The chairman in the past has demonstrated how sensitive he is to the political mood in the moment. If unemployment starts climbing, do you expect to see the same Chairman Powell again?
Well, I don't know if we'll see the same Chairman Powell again, but do I think that the Fed will respond to a loosening in the labor market? I think they're waiting for that. I think all of us have been waiting for at least the participation rate to start going up. I mean, nobody wants to see outright job loss, but the big surprise has been, and maybe there's something to this long COVID story in terms of how it's impairing the participation rate. Nobody wants to see employment go down. You can actually see the unemployment rate actually go up if the participation rate starts to go up. So that's going to be very critical. But do I think that if the unemployment rate goes up 3, 4, 5 tenths from where it is today, that they're done? I think that's all it would take. In fact, usually when you get 3 or 4 tenths of an increase in the unemployment rate, the lagging indicator that it is, the recession has already started.
David.
So I think that would be enough to push the Powell pivot back on the front burner.
We appreciate your view. As always, David Rosenberg there of Rosenberg Research. TK, you know who we miss? The late, great Alan Kruger. We really need the late, great Alan Kruger to look at this labour market, TK, and just work out what's really going on. And David touched on some of it there.
He would be heated on the negative real wage in the social efficacy of bringing up minimum wage to help more than the minimum wage cohort.
Coming up, as we guide you towards the opening bout, Jerome Schneider of PIMCO, Laurie Calvasina of RBC Capital Markets. We'll catch up with Eric Nelson of Wells Fargo as well. All of that going into the opening bout, live from New York. This is Bloomberg.
Keep Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The U.S. says that a controlled shutdown of the Ukrainian nuclear power plant seized by the Russians would be the safest option. Artillery shells continue to land near the plant. Meanwhile, International Atomic Energy Agency monitors will assess the damage and account for nuclear material at the reactor. President Biden will deliver a primetime speech Thursday, slamming Republicans for what he sees as their threats to U.S. rights and freedoms. According to a White House official, the president will speak about the continued, quote, battle for the soul of the nation. He's trying to boost Democrats' chances in the November elections. Best Buy posted quarterly profit that beat Wall Street estimates. A month ago, the consumer electronics chain warned that it was under pressure from slumping demand. Consumers are shifting more spending to travel and other services. That's after they binged on TVs, computers, and appliances during the first 2 years of the pandemic. And Goldman Sachs warns that the downturn in the U.S. housing market has further to go. In a research note, Goldman says it expects home price growth to average 0% next year due to higher mortgage rates and reduced affordability. But the firm says that large price declines are unlikely. And in California, the state Senate has approved a bill that offers fast food workers a role in regulating the industry. It establishes a process for pay and workplace standards to be set by a council comprised of employees and franchise owners, amongst others. The state assembly still has to give final approval. It's unclear if Governor Gavin Newsom will sign the bill into law. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it.
You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual.
I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
I think the lead theme is that we end up retesting the June 16th low, but right now our belief is that we do not set a lower low. So right now, increased volatility, it will be a September to remember, but I think we will get through this okay.
Sam Stovall, cut from a different cloth, the chief investment strategist at CFRA Research, and they're easily 100 years of Stovall's strategic interest with his legendary father who invented the business and, of course, moving it forward there with the star ratings at CFRA. We're going to do that right now. We're going to have a difficult conversation with Barry Ritholtz. His podcast is huge. Masters in Business is smart, smart, smart. He also happens to run some money every once in a while. Barry, you hit a third rail with me this week, and we're going to get an update here because what's new now in the fee game and what Peter Lynch called diversification is people buying index funds like they're kelpers. You're taking modest small wealth, you're running it like kelpers, and you're overlaying it with really fees from years in my youth. We're not talking 20 beeps. We're talking some big fees to run index funds.
Yeah, it's kind of crazy. This past weekend on Masters in Business, I had Bloomberg Intelligence analyst Eric Balchunas talking about the Vanguard effect and how over the past 40 years, Vanguard has driven down the cost, not just for their customers, but for everybody who had to compete. And so every now and then, you'll find this anomaly of high-priced index funds, high-priced, very basic investment strategies. And, it's perplexing that in 2022, this sort of stuff still exists. It should be fairly reasonably easy to get affordable financial advice that isn't overly complex and layered with expensive fees, 2%, 3%, 4%.
But the arch matter here, and now it's more acute because we've had a horrific bond, historic bear market in the equity market, maybe not so much sport as well, is you and I and others, Arthur Levitt, who basically blew up the individual stock game. The bottom line is we thought things have changed, and still people are managing for a stick and a quarter, for 2 points, dare I say, someone's getting screwed right now for 2.5 points on an index fund that you and I didn't even, it used to be you worked at this. Now you just buy Vanguard ETF.
It's kind of shocking that, this level of, look, it's one thing if you're going to say to somebody, I have this unique strategy, and that's why I'm in a 2 and 20, and, we may not shoot the lights out every year, but that's what we're going for. And if you want to take a little portion of your wealth and throw it into that sort of highlight game, go ahead. Yeah. But the core of your portfolio, I don't understand why people are paying 2%, right, for just, very straight up asset management. Yeah. Now, if you're adding financial planning, estate planning, tax management, et cetera, okay, then some of that is built into the fees. But it's always shocking to find these, modest size accounts that are paying close to 2% for what essentially you go to a robo-advisor and pay 50 basis points or less.
Lisa, jump in, please.
Well, I just am wondering if this is just another node of froth that's going to get beaten out of the market as it becomes more difficult to get returns, right? I mean, is this basically a byproduct of a couple of years where the Fed came to the market's rescue at every turn, and you could afford to lose a 2% haircut off of whatever your profits were based on your returns, and people weren't paying attention as much?
You know, in the past, a lot of people used to say nobody really cared about fees in the 90s when the markets were going up. But if you look at the 2010s, that's the era. That decade was when Vanguard went from $1 trillion to $8 trillion. BlackRock went from $2 trillion to $9 trillion. So even in this very robust, I don't know, 13, 15% a year over that decade for the S&P 500, even in a very robust market with a strong bull bias, people still had become very price sensitive. Perhaps that's part of the reason those indexes did so well. All that money flowed to Vanguard and BlackRock, and that, you know, half of those assets went to indexes.
Barry, got to leave it there. Thank you. Really smart note there in the fee game, which we don't talk enough about here. Futures up 18. They deteriorate a little bit. The VIX 25.60 showing a better tape. Lisa, what's the ramification if credit gives way, price down, yield up?
Well, that's what people are trying to figure out. And which aspects of credit? You're already seeing that in a pretty dramatic fashion in the riskier sections of high yield, with the lowest tier, the triple Cs, now yielding an average of more than 10%, which is considered distressed, right? So you're already seeing that. So where is the canary in the coal mine? And there was actually a recent report from Morgan Stanley saying that leveraged loans may end up being just that. But until now, and this is a really important point, Tom, until now, credit's held in. And people have used this as justification for the stock rally or for the stock resilience. At what point does the credit still serve as some sort of canary for other risk assets?
I found my chart for tomorrow, Lisa. It's real simple. I just looked up the aggregate, the total summed bond chart for the Bloomberg, the Lehman, the old Barclays index. And we are right, Lisa, at the cusp where it breaks down to new, lower price, higher yield. I think this is underreported the end of August.
Well, yes, we've been talking about how the Bloomberg aggregate index has declined by nearly 20% since the peak over in January of 2021. So we've seen a massive bear market, unlike we've seen anything the likes of which we've seen over the past generation. So at what point, I know that this is your third rail, Tom, which is people don't talk about how much pain has been suffered. At the same time, people have been talking about the opportunity, because when yield goes way up, people see the yield. They're not looking at the price, especially if they weren't invested in those particular securities before. So at what point does it become attractive again? And that's what we're starting to hear from people.
The other thing that slipped through the radar today, Lisa, is that Hungarian central bank rate at 12%. How do you run a 12% interest rate economy, 11.x%, I should say? How do you run an 11.x% economy given all the shocks of Europe, including the war? I don't get.
Hike rates into weakness? How do you hike rates into instability? And that is what central banks around the world are doing.
And what's so important here, and you can do this, folks, with Ritholtz Management, you can look at Euro Forint as a part of a diversifier to your portfolio. Hungarian Forint weaker here since April against Euro. Where are you going to get information like that? I mean, nowhere else. Futures up 17. Stay with us. This is Bloomberg.
Welcome back to another special U.S. Open update for Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. Serena Williams was the only ticket in town on day one at Flushing Meadows. Serena Williams. A packed house on Arthur Ashe Stadium cheered every winner the 23-time major champion hit as she took care of business against Danka Kovanic to reach the second round. There were flashes of vintage Serena in the victory, which sets up a meeting with number 2 seed Annette Kontaveit. Serena will retire from pro tennis at the end of the Open, but the fans in New York don't want to say goodbye just yet. Oh my God! Rafael Nadal headlines Tuesday's action in the Big Apple as he looks to extend his lead in the all-time list at the Slams. The Spaniard can claim his 23rd major crown in New York. And don't forget, Tennis Channel Live at the U.S. Open hits the air daily at 9 a.m. Eastern, with everything you need to know from the Big Apple.
you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Following a two-day rout, can we find a firmer footing? Live from New York City this morning. Good morning, good morning. Your equity market positive, just about. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York City, we begin with the big issue. The post-Powell slide subsides.
Chairman Powell was very direct, very clear.
Now it's black and white. They're very aggressive.
Jerome Powell getting up and saying what he said, and boom, down goes all the speculation.
Everybody was kind of on the momentum trade. And
the interest rates of the Fed is just one element of the pricing of equity.
Now it's in the middle.
You have to be opportunistic. You have to be patient.
So far, there's been some resilience.
Valuations are more reasonable.
Short-term indicators getting oversold.
And corporate earnings have been resilient.
It's time to sit tight and react.
The market is giving you opportunities.
It's not a complicated game.
It's very, very clear that they want financial conditions to tighten considerably more.
Our advice to the institutional investor is to stay light and what I call light and tight.
Bullish, how about it could be worse?
It could be worse. Joining us now is PIMCO's Jerome Schneider, Eric Nelson of Wells Fargo. Gents, great to have you both with us. Eric, first to you, sir. Can you give me one reason to be bullish here?
John, it's hard to find one. Whether you look at the hawkishness from Fed Chair Powell and frankly other officials over the past couple weeks, you look at the European energy crisis. If anything, John, maybe positioning is one thing that maybe would help sentiment here. But from a medium-term perspective, there's a lot of challenges to get through, and it's pretty clear the Fed's resolve is quite strong for right now.
Fascinating to hear from Neil Kashkari of the Minneapolis Fed, to Tracy Alloway and Joe Weisenthal on that Odd Lots podcast here at Bloomberg. He was happy to see the reaction after Jackson Hole. He said the following: I certainly was not excited to see the stock market rallying after our last FOMC meeting because I know how committed we all are to getting inflation down. Jerome, what do you make of that, to hear the quiet bit out loud?
Well, basically, I think that you have a situation where the, quote, successful Volcker disinflation is actually, becoming more permeated in the market. One of the factors, obviously, is that if you equate this to an automobile race, when they came out of Jackson Hole, what was really signaled was that the green flag wasn't being waved, so the need for risk assets was definitely not going to be waved into portfolios. The need for a checkered flag declaring victory on inflation was definitely not going to be waved. The race was not stopped, meaning the black flag wasn't waved, and nor was the last lap with the white flag. What we found ourselves in was with the yellow flag of caution, and we're going to likely end this race for a longer period of time. That means that this race will be finished under the caution flag for most investors. And so while you're looking, and many investors are looking for a reason to be bullish, really what we have to do is take a longer term view in terms of where that calibration happens. And that successful disinflation that Jerome Powell highlighted means that they're going to be on this course, as we know, for a very long time. In fact, I think one of the conditions we find ourselves in right now is that the tightening financial conditions that we've witnessed so far, although many people would believe that there's more to come, reality is that in calibration with what we've seen in the global financial crisis, we're seeing some of the tightest financial conditions now than we've seen since Lehman Brothers at that point in time. So there is some appropriateness to where we think the market is right now. And while there might be some deterioration to come, especially if you have growth deteriorate further into the later part of this year, we do need to be a little bit more cautious. Obviously, rates have been the massive recalibration element in that tightening process over the past few weeks.
Is a hard landing secured? Bank of America thinks so. They say this: the Fed wants to reduce inflation and will risk a recession to restore price stability. We expect a 50 basis point hike in September, though strong August employment could tip the balance in favor of 75. Eric, they say this: we continue to believe a hard landing is more likely. Do you agree?
John, it does seem like the most likely outcome at this point. You look domestically, and there's certainly a lot of risks building in the housing sector in particular. The activity there is slowing sharply, and it seems inevitable that at some point price declines will come. Labor market is holding up well, as we know, but that's a coincident indicator. We probably won't see that deteriorate for at least a couple of months. What worries me the most, though, John, is the global situation. China, Europe. There really is not a sense of urgency in addressing the issues both in those economies, and at the same time we're seeing the dollar continue to strengthen. So the global situation is really deteriorating rapidly, and whereas that may have led to a Fed pivot in the past, it's really not seeming to do that right now. The Fed wants to see a stronger dollar to help that disinflationary story, and so the Fed really is firing on all cylinders right now, and that's going to continue to raise the risk of a hard landing.
And they want to see higher unemployment. That's going to be difficult to communicate once they actually get it. How do they convince people that this is a price worth paying to get inflation back down? Diane Swank at KPMG messaged me yesterday, and she said the following, and I think this is important. Park September. It's so much bigger than just September. She said this: the amount the Fed raises rates in September is less important than the direction and the resolve to slow economic growth below potential and raise unemployment. Jerome, how are you preparing clients for that moment when we start to see unemployment climb?
Yeah, we don't disagree. I think one of the factors right now is that the Fed has made itself less data dependent, at least in the near term. And though while the number for this week, the jobs number, is probably important just to point somewhat of a trajectory, it probably has less dependency in terms of that tightening process along the way. Now, you are correct, and I think the possibility of increased job losses is something that is probably longer term. And I really think that this story becomes more profound in 2023 as we do see expect unemployment to start to increase closer to 4.5%, perhaps even 5% as we get into the latter half of next year. That is going to be a consequence that we have to deal with. But when you put all these things together, as noted previously, geopolitical risks, we have risks, obviously, in Europe as we approach the winter. We also have more structural issues with regard to capital expenditure, perhaps profitability, and those things will come. It will be an evolutionary process whereby the Fed doesn't necessarily have to pay attention to growth in the near term because some of the factors are actually quite positive. Still, job momentum is remarkably strong according to BLS statistics. But in the medium term, what we really want to do is focus on the fact that there could be potentially some deterioration as we enter into 2023. 2023. And actually, to be fair, John, we are forecasting a -1% year over year to end 2022 for GDP growth. It'll flatline again back in 2023, but I think that just goes to highlight the uneven process of this healing, and that just simply picking your spot isn't necessarily something that's going to happen in the near term. It's going to be a longer race than people expect.
You're looking for some weakness in the economy. We've got some weakness in the equity market right now. We fade. On the session, we're up 1/3 of 1%, but way off the highs of the session from earlier this morning. The S&P 500 up 1/3, the NASDAQ up 1/2 of 1%. I mentioned those comments from Neil Kashkari, the Minneapolis Fed president, to our colleagues Tracy Alloway and Joe Weisenthal on their Odds Lots podcast. Citi responding to that and saying the following: Neil Kashkari is happy with the reaction to Jackson Hole, which included a significant sell-off in equities. His comments are likely indicative of broader sentiment on a committee that wants to see financial conditions tighten further. It's a clear negative for risk assets. Bloomberg's Mike McKee joins us right now. Morning, Mike.
Morning, John. Well, on the bond side, that's true. But on the equity side, you look at the futures this morning and you wonder what's going on. There are a couple of reasons why, according to analysts on Wall Street. One is doverai ni provrai, the old Ronald Reagan saying, trust but verify. The markets don't necessarily believe that the Fed will follow through and not cut rates next year. And some people are talking about that this morning. In some notes you see, basically, it's what they didn't say. They didn't say we wouldn't cut rates in 2023, so it still could be possible. It's also a lot of vacation days piling up here. The last few days on the beaches out in the Hamptons, volume very low. And then we are, as you guys have been talking about, waiting for the August jobs and CPI. But look at this. This is the calendar for the month. And on the first part of the month, the first date of the month on Friday, we get the jobs report. And then we get the CPI report on the 13th. The decision comes on the 14th. That's during the blackout period. We will not know what the Fed thinks about the CPI. So you're going to see a lot of volatility as the markets try to figure that out. Right now, they are leaning towards 75. This is the median effective Fed funds rate. So what it's showing you is they think it's going to be about 3%, and that suggests just barely getting over the hurdle for 75. But that could easily change when we get those new numbers on Friday and on the 13th.
Mike McKee, does Chairman Powell have to dial 1-800 Mike McKee and get Mike McKee to come on TV and say this is what the hike will be? Or do you think the reaction function is fairly well understood now, that if we get a downside surprise on CPI, it's 50, upside surprise, and we're getting 75?
Well, it's going to be interesting to see, because it does seem the reaction function's in place for the jobs report. Get a strong jobs report, everybody says 75. For CPI, that's going to be a little bit harder to tell, especially if it's not definitive one way or the other.
Mike McKee, thank you. September 2nd, September 13th, in the diary. Mike, thank you. Got to factor in balance sheet reduction as well. Take a listen to Peter Cheer.
What I find most difficult to talk about is, if you go back to last summer when the Fed insisted on doing QE, they kept talking about market liquidity as the reason to do QE. I can guarantee you that market liquidity, especially in treasuries, is way worse now than it was last summer. I think we've already turned the corner on the economy in a negative way. We're seeing things roll over. And I'm willing to bet that by December, we're complaining about deflation and real problems in the economy rather than inflation.
That's Pete's call. Jerome Schneider, I'd love to get your understanding, to give us your understanding and help me understand what balance sheet reduction means for this market and for this economy.
Clearly, later this week, we're seeing that knob turned up, and we're going to see the full QT come into play at that point in time. Liquidity conditions are something that have been at the top of mind at PIMCO for, frankly, more than 3 years at this point in time, ever since the repocalypse of 2019. But the reality is that the factors for liquidity continue to evolve, not necessarily in a positive way. And we see that both in treasury markets and more broadly speaking. And part of the conditions now is policy measures, QT specifically, which are going to create implications with regard to broader market liquidity and, more importantly, broader market sentiments toward liquidity. So it's almost a self-fulfilling prophecy in a way that you might actually have liquidity become a concern because it's becoming more top of mind now, simply speaking. So when we see this happen and QT come into full force later in the beginning of September, this is going to be a factor for not only repositioning portfolios, more broadly speaking, but how to think about it. And this is exactly where portfolio managers like myself want to be thinking about transactional cost, how active management can come into play, et cetera. But in the longer term, I think what highlights here, Jonathan, is the fact that from an investor point of view, investors need to be more highly convicted toward the positionings they're taking, whether in risk assets like equities or even to fixed income, which has recalibrated pretty dramatically over the past few months, to make those allocations and take a little bit longer term view than the minute to minute, day by day, or even week to week allocations that we've become so accustomed to over the past 10 to 20 years.
Eric Nelson, final word here.
John, I think there's maybe a little too much focus on the QT as a direct impact on markets. Go back to 2018, Fed Chair Powell used the autopilot comment. We had a huge sell-off in markets. What really got the market lifted at that point was, I think, the pivot on rates. QT continued well into 2019, and really the market became much healthier through the early part of 2019. It wasn't until September 2019, when the repo market really imploded, that the QT pivot came, and the knock-on effects for markets weren't that big. So I think at the end of the day, the rates are really what matters here, and that's going to continue to be very restrictive for markets, for the economy, and lead to most likely more of a hard landing than a soft landing.
I can't believe that's already 3 years ago. I remember Jerome alongside me on the morning where things were getting really dicey. Jerome Schneider, Eric Nelson, sticking with us. Let's get you some price action. We're positive 0.4% on the S&P. Let's get you some movers. Here's Abby.
Hey, John. Well, similar to the major averages, we have lots of stocks moving to the upside, but off of the highs. One of them being Best Buy shares had been up as much as 5% earlier after the electronic goods store did beat estimates in a big way. Those were lowered estimates, though, so it's a lowered bar. Lots of interesting headlines coming out of their conference call, perhaps explaining why the stock is down to some degree, but they're talking about the idea that economic conditions, they're withdrawing for 2025 targets. Holiday shopping is starting later. They're doing more promotions. They're cutting some staff where needed for cost cutting. So a little bit of a cautious tone there weighing on those shares. ASML Holding, the semi-cap equipment company, up 1.2%. The TSM chief earlier was talking about shortages in chips. This is a company that will benefit as the company makes machines to make chips. Bed Bath & Beyond, well, the meme rally goes on, and of course this company is providing a quote-unquote strategic update tomorrow, shares rallying ahead. And then Twitter, John, as you know, this saga simply goes down. At this point, the stock down a little bit here, down 0.6%. The bigger point, though, is it's well below, as you know, Elon Musk's original offer price of $54.20. Of course, Elon Musk lawyer sending a note through saying, a letter saying that the whistleblower suggests that his claims are more valid. The Twitter lawyer saying, no, not so much. This saga goes on. We'll be digging into it more later, John.
They'll battle that one out in court. Abby, thank you. We'll talk about that around the opening bell. Coming up, ECB officials clashing over the size of its next rate hike.
We should be humble about how the markets and the financial system responds to large rate increases.
Plus Europe ramping up efforts to curb power prices. That conversation up next.
Consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco. Last month's jobs report caught everyone off guard.
This is quite a surprise. Oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report, Friday on Bloomberg Television and Radio.
We should be humble about how the markets and the financial system responds to large rate increases. So if you're going to deliver the same amount of cumulative hiking in a given window, you can also make midstream corrections. There's more upside risk to inflation than downside right now, but there could be reversals on many dimensions where the terminal rate is not always going to be revised upwards.
The ECB debating the size of the next rate hike as the region braces for the latest read on inflation. This coming as Russia curbs more gas supply to the region. The French energy minister saying, quote, "We're getting ready for the worst case scenario, which is a complete cut-off." The EU now planning on emergency intervention to prepare for winter. Team coverage starts right now with Bloomberg's Lizzie Burden and Gillian Lee in London. Lizzie, walk me through the big debate at the ECB.
Well, looking at economists' notes overnight and speaking to them as well, if they haven't already changed their call from 50 basis points to 75 basis points, they're probably thinking about it because of all those hawkish comments at the Jackson Hole meeting over the weekend, Schnabel, Wren, Villeroy, but also because of what Powell said. You know, the Governing Council can't ignore that the BOE and the Fed are making the ECB look behind the curve at this point. It's despite what Philip Lane said, you heard it there, he wants a steadier pace of rate hikes. He is, you know, very influential as chief economist. If economists are sticking with a call of 50 basis points, that's why. It's not really because of the inflation data that we had today. Spain declining from its record high in July, Germany rising in line with expectations. That's not really moving the dial, although of course we do get more data tomorrow.
If they can tell me what's going to happen with gas prices, I guess we can all tell them what they should do with interest rates. Julian Lee, I've got no idea what's going to happen with gas. We're now talking about intervention. Julian, do you have any understanding whatsoever over what that intervention is going to look like?
I think what they're going to try and do is find some way of delinking electricity prices from gas prices. At the moment, all the formulae link electricity to gas because gas is the marginal generation fuel. You've got your base load electricity generation that comes from nuclear and increasingly from renewables. And then you've got gas that provides to some extent, the swing between the peaks of demand either on a daily basis or on a seasonal basis. And so electricity is tied to that marginal generation fuel. What the European Union is looking at and what I think the UK government maybe will look at is how you break that link so that electricity prices better reflect the overall cost of generation rather than just that very high at the moment marginal cost of generation.
We'll see what the plan looks like when it comes together and gets confirmed. Gillian Lee with some insight there alongside Lizzie Burden, who ran away from the piano as soon as we said she might have to play it. I noticed that. To both of you, thank you. The euro right now, 100.25, and I think we're all getting a little bit more comfortable, even though it's uncomfortable, with the idea that this could go on for more than one winter. The Shell CEO, Ben van Beurden, saying it may well be that we have a number of winters where we have to somehow find solutions. He went on to say that this is going to somehow be easy or over, I think, is fantasy we should put aside. Eric Nelson, with that in mind, you've been looking for a weaker euro, you've had one. I look at all of this, I think of the prospect of it going beyond one winter, maybe five. And I'm asking myself, not why the euro's down at parity, why it's not even weaker, why it's not collapsing given everything we're throwing at it.
Yeah, John, a big issue here is we're in the first or second inning of this crisis, and it's still extremely unclear what the economic impact will be. and we still haven't gotten there yet, right? A lot of the, say, the consumer measures that sort of aimed at limiting cost increases are set to take place in October. So, for instance, the UK energy regulator raising the annual energy cap or Germany's natural gas levy, these things don't take effect for a little while. We're just having seen the price increases in the past couple weeks. We haven't seen the knock-on effects on the industry in Germany. We're now starting to see some insolvencies at the utility level. Yeah. So the system is slowly starting to break, but we haven't seen it. And until we see the actual economic impact, we probably won't see euro break lower. But the key thing here, John, is positioning just is not as strong as people think. We still see more room for euro to go lower here.
The key thing here is that the ECB is willing to hike into this mess. Jerome Schneider, I've got 30 seconds with you. I wanted a final word with you on this. Did you ever think that you and I would be talking about a 75 basis point hike at the ECB?
Probably not. You know, I think my partners over in Europe are actually celebrating a bit now that we actually do have some positive yields in a way, although the winter is no cause for celebration in Europe. But I do think that what we need to be reflective here is one thing. We need to be looking the gift horse in the mouth, finally, around the world. And when you think about yields where they've been at the front end, both in Europe as well as the U.S., the opportunity set for investors is to accept the gift horse present and actually say this is a place to actually take some risk off the table and put some carry in portfolios and earn some income from the front end of the global yield curves.
And give Jerome Schneider a call. Seems to be the pitch there. Jerome, alongside Eric, to the both of you, thank you. Up next, your morning calls. Then later, Lori Cavacina on why she thinks the June low may well be the low.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Live from New York City, equities up just about. Let's get you some morning calls. First up, Barclays upgrading the gap to equal weight, highlighting the retailer's recent moves to address major risk factors. Next up, Cowen raising its Lululemon price target to $5.12, saying shares look undervalued heading into earnings. And finally, D.A. Davidson raising its price target on Overstock.com to $98, pointing to improving e-commerce trends. Coming up, Lori Cavacina of RBC explaining why she thinks stocks won't be revisiting their June lows. That conversation and the opening bell up next.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. From servers to software to the cloud and beyond, HPE is transforming its business, and Tara Grobiati is central to the task.
Gone are the days where the CFO is just a scorekeeper. Our role as CFOs is to assist the CEO change the score.
Chief Future Officer, Wednesday on Bloomberg. Brought to you by Workday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Following a two-day rout in this equity market this morning. Good morning. This morning's price action struggling to stick. Futures positive just about 1/3 of 1% on the S&P 500. On the Nasdaq 100 up about 0.6 of 1%. Over the previous 2 days, the Nasdaq down about 5%. The S&P 500 down 4. Brutal. Let's see opening bow, switch at the board and get to the bond market. That move fading as well. The yields look a little something like this. Now unchanged basically on a 10-year at 3.1062%. The euro just about stronger. Euro dollar positive 1/3 of 1% at 10030. Danske Bank looking for 75 basis points from this ECB next week. September 8th in the diary for all of us. Crude backing away down $3.20. We're off by 3.2% to $93 and about 90 cents. About 20 seconds into this one, let's get you some movers. Back with us is Katie.
Hey, John, well, it's the opposite setup so far from yesterday's open. You have tech leading early gains. They're tepid, but they're still gains. Apple rebounding after just a wipeout yesterday, down more than 1.4%. Still 0.5% higher, not much to write home about. NVIDIA also getting a boost. Chips broadly rebounding this morning, again following what you could call a wipeout yesterday and on Friday. Meanwhile, earnings season continues to roll on. You had Best Buy beat profit estimates this morning. Of course, that comes a month after the company cut its forecasts, but still, it was a beat. You have shares 4% higher. Down at the bottom of the screen, you have Chevron falling from the bell as oil drops down over 3% after Iraq said it will keep pumping, John.
Energy, where the underperformance is, and Katie, thank you for that. You see that on the S&P, we're down about 1 full percentage point. As an industry group, top of the pile right now, consumer discretionary up 0.8 of 1%. The S&P up about 1/3 of 1%. Drama, wherever Elon Musk goes at the moment, just not in the stock price of Twitter right now. We're down about 1/10 of 1%. Elon Musk citing a whistleblower claim in his most recent effort to scrap the $44 billion Twitter deal. The latest filing reading the following. These allegations, if true, demonstrate that Twitter has breached the following provisions of the merger agreement, thereby giving the Musk parties the right to terminate the merger agreement. Abby, are you up to speed on this one?
This is just incredible, John. And, you know, I think that we all had a sense back on April 14th when the bid by Elon Musk was originally made for Twitter at $44 billion or $54.20 that something might not stick. A lot of people talked about how high it was at that time. And now we just have the latest saga in this deal. Of course, that whistleblower last week, Twitter's ex-head of security, claiming all sorts of things around the company that they did wrong around privacy and other such issues. So Elon Musk's lawyers recently, as you just mentioned, raising this for another reason to terminate the deal. Twitter striking back, saying, no, we have not done anything wrong. This is not a reason to terminate the deal. Twitter at this point, to your point, down just a little bit. Tesla, another barometer on this deal, up just a little bit. But the biggest barometer, because of course, if this deal doesn't go through, folks think that Elon will have more room, more time for Tesla, is the gap. Follow the money. So of course, that deal price, $54.20, right now down below it by almost $15. So the markets are saying they don't think that this deal is going to happen. Or another way of looking at it, John, is maybe they think that it will happen, but at a lower price. And that was a lot of the speculation circulating back in April. And one other reason to think that maybe some sort of deal is going to happen, Elon has sold quite a bit of Tesla stock, basically 50 million shares, let's call it roughly $20 billion. We don't know exactly where he sold it, but he could be raising money in case he's forced to execute the deal at the $44 billion deal. Or who knows, John, maybe they do come up with a lower price. It does seem that Elon would like to have control of this platform based on the fact that he put in the bid, but maybe he regretted that price. So who knows? Maybe it will happen at a lower price.
Abby, thank you. April feels like a lifetime ago for all of us. Abby, thank you very much. Twitter down about 0.1%, a really marginal move. On the S&P 500, positive about 1/3 of 1%, call it 1/4 of 1% higher. The moves in the bond market have contributed to the volatility of the last few days, that's for sure. At the front end now, up 2 basis points to about 344. Yesterday we came very, very close to the closing high of the year, Taylor Riggs. We're starting to get a lift at the front end again this morning.
Yeah, another lift towards the highs that we haven't seen really since 2007. So that's certainly something that we're watching in the markets, and also that some Fed officials too are watching. I think it was interesting, Neil Kashkari yesterday talking a lot about sort of the equity markets as well, John, as we go cross asset, saying that maybe the markets are finally getting the picture. Maybe we're finally waking up, realizing that there was never a pivot. Maybe we made that up, and that the equity market falling is sort of signaling that we're finally believing that this is a Fed that is going to move and tackle inflation. That's sort of what you're seeing in the VIX. I would note that we've made a lot about maybe rising up to 24, 25. Nowhere near the 30, 40 levels of previous blowouts, but at least a little volatility starting to rise up. But again, sort of calmness, what does that mean? I think when we think about sort of the math of rates higher, we know that the pressure that puts on PE ratios. Some people are looking at the big drop on the right-hand side of that screen and saying that PE ratios have fallen. And in sort of the yellow areas, we've highlighted sort of the bottoming out of PE ratios of previous bear cycles. So we're not quite there yet, but we've certainly come a long way off from where we were around the highs of 2020. Finally, though, when we think about the bond market, maybe this is where we take our signals. Morgan Stanley, an interesting note, instead of looking at high yield, maybe we should be watching leveraged loans. Regardless of the market we look at, a bond market that's telling us maybe we're near bottom. We're actually closing down about 20% from some of the recent highs.
Was that Sri Sankaran over at Morgan Stanley? I think it was.
Yep.
Fantastic note. Taylor, just briefly, was it refreshing for you to hear Neil Kashkari say the quiet bit just out loud?
Ooh, maybe, because on our program, we had been talking about was there a pivot, was there not? And I think we finally got clarity. There was no pivot. We made that up.
We made that up. I think other people out there made that up. Taylor, not us, that's for sure.
And maybe the markets are finally realizing this is a Fed that's taking inflation seriously. How you value that then depends on how you think about the path of rates.
Taylor Riggs, thank you.
We don't make up anything.
As always, we don't make up a thing. Neil Kashkari, if you're just tuning in, this is what he had to say to our colleagues and friends Tracy Alloway and Joe Weisenthal in their Odd Lots podcast, which you should all take a listen to. I certainly was not excited to see the stock market rallying after our last FOMC meeting because I know how committed we all are to getting inflation down. He was happy with the reaction to Jackson Hole. I asked the question a few times this morning. If you're long, are you fighting this Fed? If you're bullish, are you fighting this Fed? Sebastian Page at T. Rowe Price said to us this morning on Bloomberg Surveillance, you are fighting the Fed if you're bullish. That's why a lot of people think the Fed put is now a Fed call. Lori Calvasina, though, she thinks we might not revisit this year's lows. Lori Calvasina says this: we think it's more likely than not the US equities saw their lows in mid-June, but have expected conditions to turn choppy again in the months ahead, with risk that the S&P 500 will retest its year-to-date low again in late 3Q. I'm pleased to say that Lori joins us now. Lori, I'm going to ask you the question that I asked T. Rowe Price's Sebastian Page. Are you fighting this Fed if you're bullish right now?
Hey, John, thanks for having me on as always. And look, I don't think we're fighting the Fed with our call of 4,200 at this point. And I want to remind everyone, strategists, most of us make that as a year-end call, not sort of an intra, sort of year high or low. But look, I think that the Fed at this point in time has said a lot of things that a lot of people who had been more critical of the market rally already understood, that the Fed was going to take inflation seriously, that the Fed was going to tolerate some pain. And I think in particular, the idea that they're going to willing to tolerate some pain on the labor market is something we really have to dig into. And frankly, John, I look at the S&P. I also look at the Russell 2000. I think it's a very important barometer of market sentiment when you're in periods that are challenging economically. And what I see pretty clearly in the Russell 2000 stock prices is that they already baking in a material spike in jobless claims from here that hasn't happened yet. So, when we sort of think about the trajectory of stocks through the end of the year, we have about a 60% conviction that we saw the low back in June. Now, that doesn't mean we're not going to take another swing at it, that we're not going to see some additional volatility. But I think the market will be hard-pressed to really go too far below that at this point, just given what's already baked in terms of labor market pain.
A couple of things to unpack there. Let's start with the final point. And I'll try and make it really simple, and you can tell me what you really think. If we're already back at the June highs on a two-year yield, Laurie, what business do we have being 10% higher in the equity market than the June lows?
Markets are looking forward, and I think at this point in time, the debate is really not over what kind of economic damage we incur in the back half of this year. Obviously, we'll pay attention to that, but I think the debate, when we think about how markets are going to trade in the fourth quarter of the year, is really what is the setup for next year. And if you think that we are going to have some sort of recovery, even if it's a tepid recovery, I think that markets do deserve to sort of trade back a bit from those lows that we saw in June. If we end up sort of tipping into a second half of 2023 recession, a mid-2023 recession, I think that our 4,200 call is probably going to end up being wrong. I think you have to make a call on whether or not we incur most of the damage over the next few quarters, or if it gets pushed into late next year. And my sense is that it's more of a near-term issue than a longer-term problem.
Interesting. That's a split with you and Chris Harvey of Wells, because he thinks maybe the first half of 23 is where we start to see the damage. Mike Wilson's Morgan Stanley's Mike Wilson is expecting to see that pretty quickly in the second half of this year. Laurie, the other piece that I wanted to pick out here is just on small caps. It's something you said just a second ago, and you said it in your note as well. The equities in the US are more interesting through a small cap lens. Can you build on what small caps are pricing and what large caps aren't?
So I think that small caps have done a little bit more of the work in terms of pricing and some of that deterioration in the labor market. And I think the reason why is if you look back historically, small caps usually make a big pivot and start to outperform large caps again once the unemployment rate starts to tick up in the middle of recession. So I think small caps, frankly, are just more attuned to the labor market trends that are coming as opposed to the ones that we've been living in the past. I think the other things that small caps capture very well is differing views on the economy by geography. If you look at current positioning of Russell 2000 futures, they've actually been below financial crisis lows in the future market. If you look specifically at the asset manager group and the CFTC data, think about that for a minute. The sort of domestic bucket in the U.S., people have put on these massive net short bets, and they're worse than what we saw at the heart of the financial crisis. So the pessimism on the U.S. economy expressed through small caps is already pretty severe. But I'll tell you, John, what I've been hearing from investors as I've been out on the road in August is everyone's worried about Europe, whether it's through mortgages, whether it's through energy prices, and the U.S. is viewed as a safe haven to some extent. And when that ends up happening, U.S. equities do funny things. They end up not being hurt as badly as people would normally expect, and you do tend to see small caps be the big beneficiaries of that kind of domestic trade.
Laurie, have you managed to find an equity bull in your conversation with clients? I keep asking that question this morning.
It's a great question, John. I actually got asked this in my last road trip. And what I told people was, it's sort of similar to what you see on CFTC data on asset manager future positioning, which is, sort of ticking up for equities, but still very, very low versus history. I'd say my conversations, it's about 85% pairs, 15% bulls. I do feel like that 15% has grown just over the last month or so. And what those people in that, the people in the 15% category, they're not making big market calls, but they're saying, look, I don't know what's happening with the market, but I do think there are interesting bits and pieces to pick apart.
Everyone's bearish, and for some people, that's reason to be bullish. Laurie, I know you've got thoughts on the midterms and the conversations you've had with clients as well, so let's do that next. Coming up, the Biden administration defending the Fed's efforts to rein in inflation.
He gives the Federal Reserve their independence to make the monetary decision on how to deal with inflation. We believe they have the strongest tools to deal with that. But we know that Americans are feeling the pain of higher costs, higher prices.
We'll see if the mood changes, if unemployment starts climbing. A conversation still ahead.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I went back and looked, and very few secretaries of state in the last 100 years, or maybe ever, have really gone back into government. So why did you want to come back into government for any issue when you've got 8 grandchildren, you've got 2 daughters, you've got wonderful family? Why did you want to come back and go through this terrible process we have in Washington of getting things through consensus and getting people to agree to what you want to do?
Because I want those grandchildren to have a future. It's very simple. We're not on a good track right now. The world is not serious enough about reducing our emissions fast enough, David. And the result is that the planet is going to continue to evolve in reaction to what we human beings are doing to it, mostly through fossil fuels. Most of the emissions that are going up nowadays into the atmosphere and are creating this increased level of energy that comes from the ocean, goes into the storms, the floods, the rain. All of it is explainable, and it's all linked to the changes we are creating on the planet. So it's very simple. I wanted to come in because I think we have a real chance now to make something happen, and I think Glasgow was a major step forward in the effort to do that.
Of cryptocurrencies today, you think it's now's the time to get in, it's good, or now's the time to wait to see where the market's going?
The biggest thing I would say is don't put in more than you're, fine losing.
Gives the Federal Reserve their independence to make the monetary decision on how to deal with inflation. We believe they have the strongest tools to deal with that. But we know that Americans are feeling the pain of higher costs, higher prices. Our goal is to keep bringing down inflation without sacrificing the historic and life-changing economic gains that we have seen this country has made over the last 18 months.
The White House defending the Fed following Senator Warren's latest comments. This coming as President Biden gears up for a primetime speech this week ahead of the midterms down in D.C. Here's Emily Wilkins. Hey, Emily.
Hey, John. So, yeah, it's very interesting. The White House really coming out yesterday defending the Federal Reserve and their aggressive hike in interest rates. This comes as you saw just a few days before Democratic Senator Elizabeth Warren coming out and criticizing the Fed for their move, saying that she was worried that it could lead to high unemployment. Certainly, inflation, it is a major concern for the White House. It's the main thing that Republicans are latching onto as they make their pitch to voters in November. And it really is. I mean, I've talked to Democrats, I've talked to Republicans who have been out there on the campaign trail, this is coming up for voters. It is a big, big issue on their mind, and it's going to be a big issue going into November. At the same time, Democrats, they're not necessarily trying to shy away from addressing the economy. You've heard Biden really tout the low unemployment, but you're seeing them now talk a little bit more, go on the offense, talk about Republicans, and sort of try to paint them as a more extremist party. They try and tie this to things like the recent abortion ruling, anyone who supports a ban on abortion. They talk about those who still say falsely that the 2020 election was stolen. So expect to hear some of those elements when President Biden speaks in Philadelphia on Thursday, and expect to hear those from Democrats really across the spectrum to some degree. You're going to see a lot of Democrats kind of pointing at their Republicans opponents and saying that they're a little bit too aggressive, that they're a little bit too extreme. But at the same point, again, this is a pitch Democrats are trying to make as they're trying to push back against historic inflation, which, you know, it's the party in power that always gets blamed, and it's Democrats that are being blamed right now for the high prices we're seeing at the grocery store, in mortgages, in rents, and still at the gas pump. It's come down, John, but it's still high.
The good news is that unemployment is 3.5%. The bad news is that the Federal Reserve, for many, many economists that come on this program, are looking to get that higher to get inflation lower. And there seems to be a disconnect between the Federal Reserve's objectives and the goals of this administration. And when Karine Jean-Pierre, the White House press secretary, said the following, "We don't want to step on what the Federal Reserve is going to do," that makes sense for now. But when they tell me our goal is to keep bringing down inflation without sacrificing the historic and life-changing economic gains that we've seen this country has made over the last 18 months, Emily, isn't there a disconnect between what is about to happen with this labor market if the Fed is ultimately going to be successful here on getting inflation down?
I think you make a great point, John, and we've heard that mimicked by a number of economists who have said that, you know, this is part of cooling the economy by aggressively raising these rates. I think to a certain extent, there's always a certain degree that yes, the White House, the person in charge, is making decisions that have an impact on the economy. But I think, as we've also seen, there is a lot that the Biden administration really does not have control over right now. To a certain extent, this is a game of messaging. This is a game of narrative. This is trying to predict what's going to be happening next and then kind of get in front of that. So I think there are really just a lot of questions between now and November, and we're really going to have to keep a very close eye on what the markets do, on what happens with inflation. Certainly, those are numbers that are being monitored very closely by the White House.
By all of us as well. Emily, brilliant, as always. Emily Wilkins down in Washington, just setting the stage for the big debate in Washington ahead of the president's address later this week. It's slowly creeping on the horizon and coming onto the radar of many investors as well. Lori Calvasina of RBC had this to say. U.S. equity investors were anticipating a strong showing for Republicans in the midterms as the summer got underway, which contributed to the summer rally in the stock market. But the data has been telling us that risks to this consensus view have been growing, which we have viewed as a likely source of volatility in the coming months. Lori's back with us. Lori, a number of months ago, it was going to be Republicans take the Senate, they take the House. Now the view is a little bit more mixed. Why does that matter?
It matters, John, because when markets were coming off the lows in June, one client meeting after another, they were shoving charts in my face of the midterm elections and how stocks usually bottom in October and rally through year end. And even though investors were deeply bearish, they were getting excited about that. So that was one of the big reasons, in my opinion, that stocks had that fierce move in July. And I think going forward, we all know that markets react as much to rate of change and shifts in direction as they do levels and outcomes. And I think there's plenty to worry about in the data. The polling data is shifting back in Biden's favor. If you look at how gas prices have come down, that seems to be helping him for now. If you look at the generic congressional ballot, we're starting to see the Democrats look a little bit better than Republicans there. That's a recent shift that's sticking. If you look at the betting markets, which I know a lot of people think are garbage, but a lot of people on Wall Street watch them anyway, they're now anticipating that the Democrats are going to stick the Senate or keep the Senate, and you're actually starting to see some movement in the House race, which is still expected to go to Republicans, but the Democrats are starting to make a move in that poll as well. So I think the data is really starting to shift and highlight that the kind of news flow that's shifting in Democrats' favor a little bit, it is showing up in the data. I think this is still going to go Republicans' way for at least one chamber in the end. That should help us in the fourth quarter. But between now and then, it's just another excuse for markets to sell off and people to take some profits.
Well, right now, we're fading on the S&P 500 by about 1/10%. On the NASDAQ, we're now unchanged. Lori, we started the conversation about whether we're going to retest the June low. I want to finish the conversation there. Strategas had this to say on this very debate. The greatest risk to the economy and markets may be the Fed's need to tighten more than risk markets anticipate. Market bottoms are usually associated with lower earnings multiples, a higher VIX, and a blowout in high yield spreads. We've not seen that yet. Laurie, just as a final word, what would you say back to that?
Look, I think that those are definitely relevant issues, but I do think that the biggest risk we have right now is that we talk ourselves into a deeper recession than we necessarily have to have. And so I think the pivotal thing to be watching in the coming months is corporate reactions to what's been going on. Corporate reactions are going to be seen in conference season right after Labor Day. We're going to see them in earnings reporting season too. But I think really all this is going to come down to is how many jobs companies decide to cut. I'm optimistic that they will not cut into the bone, just given how tight the labor markets have been. We obviously know that's all trending in a negative direction. I think the market can handle some cuts. Can they handle severe cuts? Probably not. And I think, to me, that is really the biggest risk we face in the back half of the year.
Laurie Calvasina of RBC. Laurie, love catching up with you, as always, just breaking down some of these big issues and also talking about midterms and the political consequences of that for the first time. Here's some news for you from Reuters. Taiwan's military fired warning shots at a Chinese drone. The first kind of headline we've seen like this since all of this really started to get going when Speaker Pelosi visited. Taiwan's military fired warning shots at a Chinese drone, according to Reuters, that headline coming out moments ago. Equities fading. I brought that up a moment ago. I'll do that again about 23 minutes into the session. We're down about 0.1% on the S&P. The real underperformance coming from energy, down about 3.6%, largely reflective of what's happening in the commodity market. Crude lower by 4.6% on Brent, just above 100 at $100 at about 23 cents. WTI fading by 4.5% right now at 92.66. Up next, your trading diary, live from New York. This is Bloomberg.
Is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to, quote-unquote, revitalize Japan.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We are about 26 minutes into this session, and 2 days of losses becomes 3 on the S&P. We're down a little more than 0.1%. The Nasdaq struggling to hold on to gains, pretty much unchanged on the session. That's the price action. Let's get you to the trading diary. U.S. consumer confidence and jobs data at the top of the hour. Fed President Williams speaking at 11 a.m. Eastern, followed by President Biden, 3:15 this afternoon. European CPI and remarks from Fed President Mester on Wednesday. The highlights are Thursday, ISM manufacturing and initial jobless claims. Then on to Friday. It's payrolls Friday in America, looking for something in and around 300K. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very, very hard blow to Vingroup and also to the national economy.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even